Hello friends, good morning. Today we'll take topics on derivative, business and corporate valuation, and today is going to be very important for exam purpose. Some important questions which I believe would be asked in the upcoming exam will be taken. So please pay attention. Question number 2, derivative option. This question was asked in May 11 exam for 5 marks, October 18 MTP for 6 marks, and September 2020 MTP for 4 marks. So what is the next destination? Yes, the next destination, you have guessed it right, your exam. So question is, the current market price of an equity share of Penchant Limited is rupees 420. Current market price of a share is 420. That we will call S0. Today's price is called S0. Within a period of 3 months, the maximum and minimum price of it is expected to be rupees 500 and 400 respectively. So from 420, the price can be either 500 or the price can be 400 rupees after 3 months. If the risk-free rate is 8% per annum, if the risk-free rate is 8% per annum, what should be the value of a 3-month call option? You have to find the value of a 3-month call option using the risk neutral model if the strike price is 450. The strike price, exercise price is 450. You have to find the value of the call option today. And which model you have to apply? Risk neutral model. Risk neutral model means investor is risk neutral. He is not affected by the risk. He wants the same rate of return, which is equal to risk-free rate of return. Because he is risk neutral, so even if the risk is more, he would not be affected by that. He would be happy with a risk-free rate of return. So this type of model is called risk neutral model. There are several models for valuation of an option. This is one of them and more important for exam purpose. First what I'll do, I will give you a small note on risk neutral model. Those who want to write down can write it down, and those who want to just listen to me can listen to me. So I am going to give you a small note on risk neutral model. In case if you have forgotten, then it will be helpful to you. And if you are well versed with this, then you can simply listen to me. Let other student write. So write down, investors are indifferent to risk. Investors are indifferent to risk. Indifferent to risk means investors are assumed to be risk neutral. Investors are assumed to be risk neutral. So what is his expected return? His expected return is equal to RF. RF means risk-free return. So his expected return will be equal to RF. So very briefly, I'll give you steps involved to solve the problem of risk neutral. Steps involved in solving the problem of risk neutral model. Write down step 1. Step 1. Step 1. This is also binomial model. This is one of the binomial models. Okay. Please reply when I will ask you the question. First, step 1. Compute the value of the option at 2 stock prices. Compute the value of the option at 2 stock prices, 2 possible stock prices. In our question, the 2 possible stock prices are 500 and 400. And the exercise price is how much? 450. The value of the option can be found out. Step 2, write down step 2. If you are writing, compute upside probability and downside probability. In risk neutral model, step 2 is important for cracking the question. You have to find out what is the probability that the stock will go up and what is the probability that the stock will go down. And how do you find the probability of price rise? Write down probability of price rise is equal to probability of price rise is equal to P is equal to R minus D upon U minus D. R minus D upon U minus D. Then your question is what is R? Write down where R is equal to the amount to which an investment equal to the current price of the underlying asset will grow. Current price of the underlying asset will grow if invested at risk-free rate for the duration of the call. If invested at risk-free rate for the duration of the call. If invested at risk-free rate for the duration of the call. So what does that mean? Now look at your question. The current price of the share is 420 rupees and the option has a time of 3 months. So if it is invested for 3 months, e to the power RT. In your question last line they have given you the value of e to the power 0.02 or something. So that is for finding the future value. That is what will be the price of the share after 3 months. What will be the price of the share after 3 months when invested at the rate of, what is the interest rate? 8% per annum for 3 months, compounded continuously. Now, how do you know you have to use continuous compounding? The last line of the question, e to the power 0.02. That is the formula of continuous compounding. So if 420 rupees is invested for 3 months at the rate 8% per annum compounded continuously, what will be the value? That is the meaning of R. Now write down D. What is D here? D is the lower possible price. D is the lower possible price of the underlying asset on maturity. So in our example, D will be equal to 400 rupees. That is when the price of the share goes down, what will be the value? 400 rupees. Then your question is what is U? U means D for down, U for up. Okay. U means higher possible price of underlying asset on maturity. So in our example, tell me everybody, what is U equal to? 500. Very good. U equal to 500. So D is 400, U is 500, and you have to calculate the value of R. R is equal to this number. That will give you probability of the price rise. By what is the probability that the price will rise? Okay, now write down step number 3. Step number 3, write down. Step number 3. Step number 3. Value of call on expiry date. Find the value of call on expiry date. How do you find out? It is the weighted average of the values in step 1 with probability computed in step 2. So in the step 1, we have two values of call option when the price goes up and when the price goes down. In the step 2, we have probability that the price will go up and we have the probability that the price will go down. So multiply these two and you will get the value of call option on expiry date. But I don't want the value of call option on expiry date. I want the value today. So then you have to compute the present value. So last step, step 4, compute the present value of expected value. Compute the present value of expected value. Compute the present value of expected value in step 3. In step 3, by discounting at risk-free rate. By discounting at risk-free rate. Okay, very easy. Once you know the steps, you will find it very easy. And now I'm going to just apply these 4 steps in solving the problem of risk neutral model to find the value of a call option today. So first we'll draw a diagram. Now here the answer starts. Today the price is 420. Write down 420. And after 3 months, the price can be 500 or the price can be 400. S1 can be 500, S2 is 400. Compare with the exercise price 450. Compare with the exercise price 450. And you have to find the value of call option. If S1 is 500, exercise price is 450. Please reply, what will be value of call option in that case? 500 minus 450. The value of C1 will be 50. Very good. And if the price is 400, exercise price is 450. Call option will lapse. Option holder will not suffer the loss. Call will lapse. So C2, write down C2, typing mistake. C2 is equal to 0, write down. So when the price is 500, value of call is 50. When the price is 400, the value of call is 0. It will lapse. Now I have to find out what is the probability that the price will rise. For that, we'll have to apply the formula that we have learned. Okay. So now write down below probability of price rise. Probability of price rise. Probability of price rise. P is equal to, now instead of writing R, I have written spot rate into e to the power RT. Okay, spot rate into e to the power RT minus D upon U minus D. Upon U minus D. Spot price is 420. E to the power RT is given in the problem. E to the power RT is given in the problem. 1.0202. Okay. Minus 400. Divide by, this you have understood. If I take e to the power r is 0.08 and time is 3 by 12, this becomes equal to e to the power 0.02. And in the problem, the value of e to the power 0.02 is 1.0202. So who got the answer? One student, Rishabh, has given the answer. 0.2848 you are getting? Yes, probability is usually written in fraction 0.2848. You can write in percentage also. Rishabh is right, 28.48%. Step 2, write on probability of fall in price. Probability of fall in price. Come on everybody. Please reply. Every student who is watching the lecture must reply. Yes, come on Mehul. Reply. What is the probability of fall? 1 minus previous answer. So that is equal to 0.71516. Okay. These are the two values of call option on expiry. These are the two probabilities. You will get 50 has this probability. You will get 0 has this probability. So now you can multiply the value with probability. You will get expected value on expiry date. Okay. Step number 3. Value of call option on expiry. Priyanka is right. Mehul is right. Very good. Come on, keep replying. Value of call option on expiry. So you just take the previous two answers. 50. This is 50 at the top. Into the probability of getting 50. 0.28484 plus 0 into probability of getting 0. 0.71516. So please reply what is the answer. You are getting 14.242. Very good. Now what you will do, this is the value on expiry after 3 months. What is the value today? The value today will be present value of this number. For that the present value factor is also given. So present value of call, write down last step, present value of call is equal to 14.242 divided by e to the power rt, divided by e to the power rt, because we want to use continuous compounding, we want to use continuous discounting also. So when you have to use discounting, this will be written in the denominator. Anybody who wants to reply, and this figure is appearing in the question, don't calculate, this is there in the question. 1.0202 divided by 1.0202, come on, the answer is 13.96. Sidana is right. Anybody else who wants to reply? 13.96. Most of the time in the exam the risk neutral model is like this only. They will change the figures but basic concept will be the same. It was easy if you know it. That is for most of the questions, if you know it. Okay. That is for every question. If you know it, it is easy. Priyanka Kabra is right. Very good. Now we'll go to one more important question. Write down important for your coming exam. This question is based on multi-period binomial model, that is American option. Another highly tested question for exam purpose. Mehul is right. American call option. What is American call option? Anybody? What is American call option? What is American call option? One is called European option and one is called American option. American option, European option. European option can be exercised only on expiry date. American option can be exercised any time on or before the expiry date. American option can be exercised any time on or before the expiry date. So how to remember? European expiry EE, American anytime AA. Is it right? EE AA. So this means the option can be exercised at any point of time. Yes. So let us go with the question now. Consider a 2-year, underline 2-year. Consider a 2-year means the option will expire after 2 years. The option will expire after 2 years. American call option with a strike price of rupees 50, with a strike price of rupees 50. What is the strike price? 50 on a stock. The current price is also 50. So what are the information available? The time to expiry is 2 years. Exercise price is 50 and today the share price is also 50. And what is the type of option? It is a call option. It is an American call option. Assume that there are two periods of 1 year. There are two periods of 1 year means today it is S0. After 1 year you will have S1, S2. Again after 1 year, that is after total 2 years, you have S3, S4, S5, S6. Each period, this period is of 1 year. Each period is of 1 year. So they have broken the 2 year into two parts. One part will consist of 12 months, 1 year. Okay. There are two periods of 1 year. Total is how much? 2 years. And in each year, the stock price can move up or down by equal percentage of 20%. So today it is 50, up 20%. So how much will that be? 50 plus 20%. And suppose it goes down 40. If it is 60 here, plus 20%. S3 will be 72. S4 will be 60 minus 20%. 48. 40 plus 20%. And 40 minus 20%. 32. These are the possible prices. These are the possible prices. You have to add 20% up, 20% down. It's a two-period binomial model. The previous one was one-period binomial model. This is a two-period binomial American model. Interest rate is 6%. So you have to move backward to find the present value by applying 6% factor. Using binomial option model, calculate the probability of price moving up and price moving down. Same formula will apply. Same formula for price increase and price decrease. The one which we applied in question number 2. Then the next question. For calculating probability, you will get 2 or 3 marks. Also draw a two-stop binomial tree. So this diagram you have to draw. 2 marks for that. Showing prices and payoff at each node. So what will be the value of the option at each node, at each point? What will be the value of the option? This is called American option. It can be exercised on or before expiry date. Okay, so first what I'll do, I will give you a small note on American option. Are you interested in writing, or you treat it as a revision? In case if you have already got this note and if you don't want to write, then just listen to me. And if you want to write, you can write. Choice is yours. There are students who are interested in writing, so I will give you a small note. In the exam, this is not required. But one day before revising your syllabus, you can go through it. Please write down. Please write down steps for American option. Steps for American option. Under that, write down step 1. Step 1. Step 1, write. Draw a decision diagram. Draw a decision diagram. Draw a decision diagram and identify the market price. And identify the market price on various nodes. and identify the market price on various nodes until expiry date. Until expiry date on various nodes until expiry date. You have to draw the diagram. Then the next line, step 2, compute the status of the option. Compute the status of the option. Compute the status of the option and find intrinsic value and find intrinsic value at various judgment price and find intrinsic value on various judgment price on expiry date. Find intrinsic value at various judgment price on expiry date. Point number 3, write down. Point number 3, the value of each previous node, the value of each previous node is the higher of the following. The value of each previous node is higher of the following. Okay, so just let us continue. There was a small internet issue. So first step is to draw decision diagram. The second step is to find out the status of the option, whether it is in the money, at the money or out of money, whether the value will be positive or zero, and find out the intrinsic value. For call option, intrinsic value will be S minus E or 0, whichever is higher, and for put option, intrinsic value will be E minus S or 0, whichever is higher. Okay, that is called intrinsic value. Now the next point is find the value of each previous node. Find the value of each previous node. Write down step 3. Students in the classroom, they are writing, so let them write. Find the value of each previous node. Find the value of each previous node. Find the value of each previous node, which is the higher of the following. Underline higher of the following. Higher of the following means, since it is an American option, you can exercise afterwards or you can exercise today also. So I will choose that option which is more profitable to me. If exercising today is more profitable, I will exercise now. If exercising later is more profitable, I will exercise later. So write down point number A. Write down point number A. Compute, write down point A, expected value of that node. Expected value of that node being the weighted average value of branches, being the weighted average value of the branches which emanate from that node, being the weighted average value of the branches which emanate from that node. Emanate means originate from that node. Like the previous one, weighted average, value into probability plus value into probability. This is called value of later exercise. That means if you exercise later, this will be the value of call option. But in American option, you have a choice. You can exercise now also. So you have to check what will be the value if you exercise now. Write down, compute the value of the node if exercised at that point. This is called value at immediate exercise. This is called value at immediate exercise. I will take higher of the two, and this process we will repeat till we reach year 0. That is called base node. So last step 4, write down. Step 4 for American option. Roll back to arrive at base node. Roll back to arrive at base node. Base node means year 0, S0. This is the fair value of the option. This is the fair value of the option. So very good question on American option we are going to solve. Students who don't want to write can take a screenshot of this. Okay. First we'll draw a diagram. Check whether the option is in the money, at the money, out of money. Calculate the value of the option. Go behind, go back. Find out the value of each point which is higher of later exercise or immediate exercise. This process will be repeated till we reach the base node. Let us see the application of the theory. So write down step 1. We have to first compute the present value factor. This is a problem of 2 years. Each period comprise of 1 year. Total is 2 years. So I will have to find out the present value of each part. That means time will be 1 year and rate of interest is given in the question. How much is the interest rate? 6%. So tell me what will be the present value factor of 1 rupee at 6% for 1 year using the continuous compounding formula. So please write down. If nothing is given, take continuous compounding. Calculation of e to the power minus rt. Calculation of e to the power minus rt, which is 1 upon e to the power rt, which is 1 upon e to the power 0.06 into 1, and the value of e is, you can write 2.7183. 2.7183. So please give me the answer of this. You have to give me the present value factor of 1 rupee discounted at 6%. Time is 1 year. Anybody, any answer? Please reply. Please reply. What is the present value factor for this? So it is approximately 0.94176. Approximately 0.94176. 0.94176. 0.94176. Then write down step 2. Step 2, write down calculation of probability of price increase. Calculation of probability of price increase. So Rishabh Sadana was right. Now we'll go to step 2, probability of price increase. Formula is same. P is equal to R minus D upon U minus D. Today the price of the share is 50 rupees. 50 into e to the power RT. This you write in power. RT, write in power. Minus 40. Divide by 60 minus 40. Divide by 60 minus 40. In some books, instead of taking the actual price, they take 1 rupee as a base and they make adjustment in 1 rupee. That is also okay. You might have been taught like that. So already the factor for e to the power RT you have computed in the previous step. Kindly solve and give me the probability. 0.6545. Is the answer right? Is the answer right? For probability of price going up 0.6545. Don't multiply by 0.94, that is a PV factor. You have to multiply by future value factor. So that is the mistake you are making. Rishabh is right, Mehul is not right. So the answer for 1 minus P is 0.353455. This is the probability of price going down. This is the probability of price going up. Now you got it right? Everybody say yes. Okay. Now we'll draw the diagram, which is your question. Draw the decision tree. So write down the diagram. American call option. It takes lot of efforts to prepare such presentation. Okay. Because we have to do lot of animation. It is as good as writing on a board, but this ensures that we can do it faster and we don't make mistake. So we are well prepared in the classroom as a faculty. So write down diagram. Today the price is 50 rupees. Today the price is 50 rupees. After 1 year, the price can be 60 rupees, that is 20% up, or the price can be 40 rupees, that is 20% down. And the probability you write down along with the branches. Probability of 60 is 0.6545 and the probability of 40 is 0.3455. This is the first year, but it is a 2-year binomial model. If the price is 60, then it can go to either 72, this is after 2 years. After 2 years, the price can be either 72 or it can go down to 48. Understood? So tell me, what is the probability? Same. 0.6545, 0.3455. Write probability next to the branch. If it is 40 in year 1, then what are the two possible prices in year 2? Then it may be 40 plus 20%, that is 48. It can go up or it can go down. 40 minus 20%, 32. Is it right? Write down the probabilities also. Write down the probabilities also. Write down the probabilities also. Done. Now write down the action. What action will you take if the market price is 72 and exercise price is 50? Will you exercise or will you allow it to lapse? Market price is more than exercise price. It is a call option. You will say exercise. If market price is below 50, call option would lapse. So write down lapse. Again write down lapse. What about the last case? What about the last case? Exercise or lapse? Come on, reply. Lapse. Okay? Because in this last 3 cases, the market price is less than exercise price. So call option would lapse. So what will be the value of the option on expiry date? If it is 72, you will exercise and the value of the call option will be share price 72 minus exercise price 50, that is 22. Value of call, write down 22. Value of call, write down 22. Then write down 0 because it will lapse 0, again lapse, again 0. Okay, so this is not the answer. We have got the value of option on expiry date. So we have to now move backward and reach this circle. C means P stands for circle. Okay, circle number, just for future reference. So I will have to move backward and find the value of the option at C2, which is the higher of later exercise or immediate exercise. Later exercise will be 22 into probability plus 0 into probability, that is weighted average value, and immediate exercise will be compare 60 with 50. 60 is the value, 50 is the exercise price. So if you exercise at C2, the value of call option will be 60 minus 50, 10 rupees, because market price is more than exercise price. You have a choice. You can exercise at this point or this point or this point. Is it right? Similarly, we'll do the working for C3. After doing working for C2 and C3, we'll again move backward and we will try to reach C1. Same process. So I have to find now the value of C2, C3, C1. Right below that. But the value you have to compute now. Okay, first you write, you will understand. It seems you have not studied this chapter before. Tell me, true or false? True. That is why you have asked this query. Now this is a revision batch, so please do not over expect. And if you have not studied American call option before this, you may find it little difficult at this time, so please excuse me. This is not for the first time reader. Revision batch means there was a vision before revision. So write down higher of, koi baat nahi, it's okay. C2 write down higher of, at least I am trying to explain the way I explain in a regular batch also. Higher of the two, 60 minus 50 means immediate exercise. If you exercise at that point, and this is the expected value, this is the later exercise, 22 into probability plus 0 into probability, and then whole thing will be discounted. This whole thing will be discounted because you are moving from year 2 to year 1. You are moving from year 2 to year 1. So please tell me what will be the value of C2. It will be higher of, I will simplify it for you, 10 versus this entire number, that is later exercise. So that comes to 13.56. So the value will be 13.56. Now same way you try C3 also. At C3, that is when the price is 40, the option will not be exercised because market price is below exercise price. So value of immediate exercise is 0. This is immediate exercise, 0. This is later exercise. This is later exercise. Please solve. Because all numbers are 0, your answer will be 0. Yes or no? No need to apply any mathematics. 0 multiplied by any number is 0. So higher of the two, 0. Now we'll come to C1. Now we'll come to C1. C1 will be, what is the price today? 50 rupees. And exercise price is also 50. So the option is add the money. Add the money means exercise price and share price are equal. Value is 0. If you do later exercise, the value will be this number into probability plus this number, which is 0, into probability and multiplied by 1 year factor and multiplied by 1 year PV factor. So what will be the two numbers? It will be higher of 0 versus 8.35. Any student who got it? Yes, 8.3584 is the right answer. You can round off to 8.36 also. Rishabh Chidana is right. Any query on this? Very easy. Again, practice, you'll understand. This is called American option. Binomial multi-period American option. One more likely question and difficult question on this topic is Black and Scholes model. Have you studied Black and Scholes model? This is a question from November 2006 exam for 8 marks. So we have seen one period binomial model, then we have seen two period binomial model, but the other two models have some mistake, some conceptual problem, and that is they expect that price will have only 2 values, 4 values, 8 values, but in reality share price can be any value on expiry date, not just 2 or 4 or 8 or 16 or 32 values. On expiry date share price can have any value. So for that reason one Nobel Prize winning model was developed by Mr. Black and Mr. Scholes, and it is popularly called Black and Scholes model. They have got Nobel Prize in economics for developing this model. It is one of the most complicated financial models. Hence, there will be some calculation which we just have to accept as it is, some formula, because we will not be able to derive the formula in the classroom. It is beyond the scope of our CS syllabus only. Those are highly mathematical models, so we will just use the formula. You can see such questions are asked in the exam, so you can't ignore it also. Yes or no? At the risk of 8 marks, you can ignore if you want. You don't want to ignore. Then let us start. From the following data for certain stock, find the value of the call option. Again, call option. Usually they ask call option, easy. Stock price today S0, 80 rupees. Exercise price E, 75. Standard deviation of continuously compounded annual return is 0.4. Sigma. Maturity period 6 months. Annual interest rate R. This is R. This is time T. It's 12%. Now they have given you a table. This table will be required for calculation of values, and I am going to explain briefly how to use this table. That is what the skill that you should have. Number of standard deviation from mean. This is a normal distribution table. Have you heard normal distribution table? And these are the standard deviation from mean Z. Mean is in the center. Then they have given area of left or right one tail. Underline one tail. Underline one tail. This one tail word is important here. If D1, which we are going to calculate later, is positive, value will be 1 minus table value. Value will be 1 minus table value. And if D2 is negative, D1 is positive means here. If D1 is negative, which means we are here. If D1 is negative, take table value as it is. Take table value as it is. So I'll just repeat if you can't read it on the screen. If D1 is positive and you are given area of the left or right one tail, D1 is positive 1 minus table value, and if D1 is negative, take table value as it is. Take table value as it is. Now we will see how to calculate. To help you, they have given you factor for e to the power 0.12 into 0.05. This will be required for present value calculation. No, that is the answer. This is the answer. Time period is 6 months. 6 months means 0.5. It should be 0.5, not 0.05. Question is wrong. 6 divided by 12 means 0.5 here. Okay. So you can rectify the question. Question itself was having this mistake. And this is the value of natural log. This also I will require in solving the problem. So in the exam, you are given the values. You have to apply the values given in the problem and solve. Black-Scholes problem are usually solved in 7 steps. What is the first step? The first step is write down. Now we'll solve the problem. This is a revision batch, so we will directly now solve, but I will explain every step. The first step is called calculation of ln s by e. Ln means natural log. Ln means natural log. Log with base e. Log with base e. So find the value ln in bracket 80 by 75. 80 by 75. Question should be in front of you. Solve. 1.066667 or something. Are you getting? Right. Then write down the value of this figure, which is printed in the question, last line of the question, 0.0645. Can you see the last line of the question? You don't have to calculate. One student is saying thanks to institute ln value is given. Yes, otherwise it will take some more time to calculate, but usually given. Usually given. Otherwise there are some calculator tricks to calculate that also. But don't worry, if it is given, use it. Step 2, write down calculation of D1. Now here there is a complex formula which you have to by heart. We cannot derive this formula in our class. If we can derive, we will also get Nobel Prize. Our mathematical power in CA course is not enough to derive this formula. So this you accept it, but we will learn how to apply it. Write down ln s upon e plus r plus sigma square by 2 into t upon, in the denominator, sigma square root t. In the denominator, sigma square root t. ln s upon e plus in bracket r plus sigma square by 2 bracket close into t upon sigma square root of t. Now ln s upon e we have already calculated. This we have just now calculated in our step 1. So that is 0.0645 plus rate of interest is 0.12. Can you see 0.12 rate of interest? Sigma is 0.4, but I have to take sigma square. So 0.4 square divided by 2 into time is 6 months. So 6 by 12, 6 months will be converted into year, 6 by 12, and then the whole thing divided by 0.4 into under root 0.05. So first what you do, first calculate d1, solve this part first. Solve this highlighted part first. Are you getting 0.1645 in the numerator? 0.2828 in the denominator. Please reply. So one student has already replied. Very good. 0.5817 approximately. 0.5817 or 5816 approximately is right. This is the formula for D1. Now you please calculate D2. Students will please help me. D2. The formula for D2 is D1 minus under root sigma into under root T. Solve. D1 I have already calculated. D1 you take from the step 2, same figure. And this also denominator you have calculated here. So take the same figure. So save time. D1 and the denominator will be required in the second formula. So how much you are getting? Approximately 0.2989, or you can say 0.2988. Both are okay. If you are getting 0.2988, that is also okay. D1 is positive. This is also positive. You are given area of the left or right one tail. If you are given area of one tail, and if D1 is positive or D2 is positive, the value will be 1 minus table value. Value will be 1 minus table value for further analysis. Write down step number next. Note, because you will forget, I have written this note for you. Human memory is limited. When one tail table is given, note, write down, those who are interested, not for exam but for your future reading. When one tail table is given, we subtract table value from 1. We subtract table value from 1. Now write down step number 4. Calculation of ND1. ND1 means normal density function. That is value of the D1 in the normal distribution table. So that is n into 0.5817. Now there is a small problem. What is the small problem here? You are given in a tabular format, value of 0.55 is given. 0.55 is given, 0.2912. 0.60 is given, 0.2578, 0.2578, but you need to find the value of 0.5817, which is between 0.55 and 0.60, which is between 0.55 and 0.60. So you have to apply interpolation. What you have to apply? Interpolation and find the value of 0.5817. So this is again a new problem for you. In classroom we sometimes used to round off to save time, but in the exam the institute have taken interpolation. Okay, if 0.55 is 0.2912, 0.60 is 0.2578, what will be the value of 0.5817? So I will help you now. Write down. So basically interpolation, whatever method you know, apply it, you will get it. For D1 is equal to 0.55, for D1 is equal to 0.55, area on the left or right one tail, area on the left or right one tail is 0.2912, which is given. For D2 equal to 0.60, for D2 equal to 0.60, area on the left or right one tail, area on the left or right one tail is 0.2578. Write down. Given one school level arithmetic, given change in number of standard deviation is to change in the area to the left or right, okay. Now you understand, if it changes from 0.55 to 0.60, this area changes from 0.2912 to 0.2578. So write down. On the left side I have written change in the number of standard deviation 0.05. On the right side I have written change in the area, which is 0.2912 minus 0.2578, 0.0334. But suppose I don't want to change 0.05, I want to only bring so much change. I want to only change from 0.55 to 0.5817. By what amount the area would have changed? Is it right? If I want to only change from 0.55 to 0.5817, by what amount the area would have changed? So write down below. 0.5817 minus 0.55 is equal to left side 0.0317, right hand side question mark. So now go back to your happy lucky school days. In school days when you are running around in half pant, this kind of equations were taught to you. Is it right? So what will be the value of that question mark? Cross multiply, divide by 0.05. So write down, therefore change required. These two numbers I will multiply and divide by 0.05. 0.0211. So I have to change the area by 0.0211. Understood? This is called interpolation. Next line write down. Hence, if number of standard deviation, from mean is 0.5817, 0.5817, area of the left of the right, area of the left of the right, write down area of the left of the right is equal to 0.2912 minus 0.0211, that is 0.2701. This will be the area. This is extra effort they want you to do. Now write down hence n 0.5817 equal to, this is not the answer. Again the student can make a mistake. This is not the answer. I have to deduct this from 1. So that will give me the cumulative normal density value. So n 0.5817 equal to 1 minus 0.2701, which is 0.7299. Is it clear? Now don't be happy. We have to do the same exercise for ND2 also. We have to do the same exercise for ND2 also. I have given you the answer in detail. In case if you want, you can apply any shortcut. Okay. But you have to reach this number. This magic number is the correct answer. Now write down calculation of ND2. This time little fast. This time little fast. Just understand it is exactly the same thing. So I am not explaining. In the given question, you are given 0.25 standard deviation is 0.4013 and 0.30 standard deviation they have given 0.3812, but we want 0.2989 value. 0.2989 will fall between 0.25 and 0.30, yes or no? So when a number falls between two numbers, we apply interpolation technique. So write down given change in number of standard deviation. You see number of standard deviation is changing from 0.25 to 0.30, means 0.05 is the change. The change in the area is the difference between these two numbers, 0.0192, but I want to change from 0.25 to 0.2989 only. I don't want to go up to 0.30. So if this is the change, what will be the change in area? Solve. I have already explained it in the previous one. Please do practice of this question. If it appears in the exam, in the same way, it is a bonus mark. Okay. So this is 0.0188. Write down next line. Hence, if number of standard deviation from mean is 0.2989, the area of the left or left of right tail is 0.4013 minus 0.0188. So it will be 0.3825, very close to this number. Can you see that? Because it is 0.30, whereas this is 0.2989. In the classroom, we usually used to round off this to 0.30 only. But an institute will not agree to that. So write down n 0.2989 is equal to 1 minus 0.3825. Finally, the answer is 0.6174. If you have learned any other presentation, any other shortcut, you can do it. You will get the same result, 0.6175. Now write down step 6. Step 6 write down. Please write down step 6. Calculation of e to the power minus RT. Calculation of e to the power minus RT. That is present value factor 1 divided by e to the power RT. 1 divided by e to the power rt. I will give you the numbers. Student will solve and give me the answer. Unless you answer, I will not move. One divided by 2.7183 to the power 0.06 to the power 0.06. 1 divided by 1.06184. Are you getting 1.06184? Solve it, you will get it. And this is equal to 0.9417. If you look at your institute, they have given you the value of this 1.06. But their figure is wrong because it was for 0.05. Actually, it should be 0.5. So I have done the calculation myself. So this comes to 0.9417. Now we are ready to solve. In the institute answer, you have to fight with the institute. Last step, write down 7 value of call option. I will give you the formula, you will give me the answer. Yes, everybody should reply. I am not getting reply from some students. Value of call option formula under Black and Scholes model is S into ND1 minus capital E, which is exercise price, into e to the power minus RT, e to the power minus RT, that is present value factor, into ND2, I want the student should reply. Okay, again to help you, I'll put the values. Now at least reply. Share price is 80 rupees. ND1 we have computed. Step number 4. Minus exercise price, present value factor, step 6. ND2 step 5. Anybody? Please, come on. Yes, solve. One student, Rishabh, has answered. What is your answer? 14.78 is the right answer. So this is the steps to be followed. Okay. Now write one note. If cumulative factors are given, that is only for future, not for this question. If you cumulative word underline, if D1 is positive, take the factor directly. Which means they have already done the calculation. And point B, write down, if D1 is negative, D1 or D2 whatever, D1 or D2 is negative, then factor will be equal to 1 minus cumulative factor given. 1 minus cumulative factor given. Exactly opposite. If area under one tail is given, if area under one tail is given, the question which we have solved, and if the D1 or D2 is positive, 1 minus table value. Okay, and if D1 or D2 is negative, then we'll take the table value, right? But if cumulative factors are given, means already they have done the calculation. If D1 or D2 is positive, take the factor directly given in the problem. But if D1 or D2 is negative, then 1 minus table value. Then we'll take 1 minus table value. So this way they can ask question in the exam. Anything is possible. Okay. Now we'll go to next concept called over the counter derivative, OTC, or interest rate derivative. So here we will see some miscellaneous type of derivative. We have seen future, we have seen option. Now we'll see some interest rate derivative like forward rate agreement, okay, currency swap, interest rate swap. This type of question we'll see. Overnight index swap. So are you ready? Okay. Over the counter derivative means they are not traded on the exchange, but they are negotiated between two or more parties. Is it right? So here we are going to solve first one important question on currency swap. This is May 11 for 8 marks, and they are repeated in RTP and MTPs also. Now the next destination is exam. So come on, write down important, because I am waiting for this question to get repeated now. It is quite a long time. We are missing you. Currency swap, we are missing you. Please come. Question is A and B. There are two companies, A in, B in, incorporated, intends to borrow $2 lakh. So A wants to borrow $2 lakh, and B wants to borrow $2 lakh in yen, means equivalent of $2 lakh in yen. So A wants to borrow in dollar, B wants to borrow in yen for a 1 year time period. The prevalent interest rates are as follows. Prevalent interest rate. Suppose A goes to the market on its own. A goes to the market on its own and it wants to borrow yen. Because it has a good reputation, it can borrow at 5%. But if A goes for borrowing in dollar, it will have to pay 9%. That is for A. B independently goes to the market to borrow in yen, it will have to pay 8%, and if it borrows in yen, in dollar, it will pay 10%. So who is a strong party here? Who is a strong party here? Who has a better reputation in the market? Who has a better reputation in the market? A or B? Quickly reply. It is not a difficult question. Who has a better reputation in the market, A or B? Please reply. Who is a better reputation? A can borrow at a lower rate, whether it is dollar or whether it is yen. So we will say A has got a better reputation in the market. So A has a higher bargaining power. A has a higher bargaining power. Got it? A has a higher bargaining power. The prevalent exchange rate is $1 is equal to yen 120. So $2 lakh multiplied by 120 is equal to 240 lakhs yen. Okay. They entered into a currency swap. So what is currency swap here? The currency swap means exchange of one currency with another currency so that both parties can benefit. What is A's requirement? Dollar. What is B's requirement? Yen. So how will the swap take place? How will the swap take place? So A will first borrow yen and B will first borrow dollar, and then they will swap yen with dollar. Why A will borrow in yen? Because interest rate is less. Compared to B, they will save 3%. If A borrows instead of B, they will save as a gang 3%. B will borrow at 10% instead of A, who could have borrowed at 9%. So there is a loss of 1% here. But still, 3% gain minus 1% loss, as a group, if they combine, they will save 2%. They will save 2%. So as a group, if they come together, they will be able to save 2%. Okay, understood? That is the power of swap. They entered into a currency swap under which it is agreed that B will pay A. B will pay A, understand, line by line, at 1% over the yen loan interest which the latter will have to pay as a result of the agreed currency swap, whereas A will reimburse interest to B only to the extent of 9%. If you can interpret this paragraph, you can solve the problem. So first A will borrow at what rate? 5%. But A will transfer to B at what rate? 1% over 5%. So A will transfer to B at 6%. B will borrow at 10%, but B will transfer to A only at 9%. B will transfer to A, it is written here, at 9%. A will borrow at 5% yen loan, transfer to B at 6%. So A will gain 1%. A will gain 1%. B will borrow at 10% and transfer at 9%. So B would lose 1% on the dollar loan, but B is also gaining 2% on, not 3, 2%. 3 minus 1, 2% on this. So therefore the effective gain to B would be 1%. A will gain 1%, B will gain 1%, both will gain 1%. Keeping the exchange rate invariant. Keeping exchange rate invariant means assume that exchange rate will not change. Assume that exchange rate will remain 120. Assume exchange rate will remain 120. Quantify the opportunity gain or loss component of the ultimate outcome resulting from the designed currency swap. Resulting from the designed currency swap. So how much will be the gain or loss to each party? Without solving only, we can say both parties will gain 1%. So A will gain 1% of 2 lakh, $2,000. B will get 1% of 240 lakh yen. 1% of 240 lakh yen, how much? Yes, 2,40,000 yen. 2,40,000 yen. That means 8 marks you can get in 2 lines only. But we have to write the answer in detail. So write down please. Write down please. Requirement. Requirement, write down. A's requirement is $2 lakh. Now how do you write the answer in the exam? A's requirement is $2 lakh. A's requirement is $2 lakh. I am teaching you also how do you write the answer in the exam, because same question, two students get 2 marks versus 8 marks. B's requirement is B's requirement is B's requirement is 2,40,000 2,40,000 sorry 2 crore 40 lakh 2 crore 40 lakh. B's requirement is 2 crore 40 lakh. Understood? First tell me whether this part you understood. B's requirement is equivalent to $2 lakh and the exchange rate is 120. Continue. Swap arrangement. So what will be the swap arrangement? I am writing in detail. In case if you don't have time in the exam, you can write briefly also. Because I have to ensure every student understands, not only few students. There will be thousands of students who are going to learn this. So every student in the country should understand. A will borrow yen 2 crore 40 lakh. Swap will happen only if they borrow in opposite currency first. If they borrow in the same currency in which they want, where is the question of swap? A will borrow yen 2 crore 40 lakh at 5% per annum from the bank and give it to B at 5 plus 1. Instruction is printed in the question. 5 plus 1, 6%. I am not doing anything here. Question says 1% more will be charged to B. Point 2 write down. B will borrow $2 lakh. B will borrow $2 lakh at 10% per annum from the bank. And give it to A at 9% and give it to A at 9%. This is how the swap was executed. Okay. If you don't have time in the exam, then you can skip this. It's already printed in the question book. Now write down diagram. Diagram would be, there are two parties, A and B. This is bank of A. This is bank of B's bank. That is, B has an account with this bank. Okay. So see practically how they will execute it. A will first borrow from its banker at 5% yen loan. A will borrow from its banker at 5% yen loan and A will transfer to B at 6%. Can you see the two arrows? A will borrow at 5%. A will transfer to B at 6%. B will borrow dollar loan at 10%. B will borrow dollar loan at 10%. Draw the diagram if you are interested. And B will transfer to A at 9%. Is the diagram important in the exam? No. But this is for understanding. See the movement again. For those who have not studied in detail earlier, A will borrow at 5 and transfer at 6. B will borrow at 10 and transfer to A at 9%. Now the question is, last line of the question is, calculate the gain or loss of the ultimate outcome resulting from the designed currency swap. So I have to present the answer for the exam purpose. Otherwise the answer is 1% of 2 lakh and 1% of 2 crore 40 lakh. So write first point A, write down. First heading write down, gain or loss to A. Gain or loss to A. Right hand side amount. How will you write the answer in the exam for full 8 marks? Question should be understood. Presentation should be such that they can't deduct even half mark. So A has borrowed from the bank 2 crore 40 lakh yen loan at 5%. So you have to pay to your own banker 12 lakh yen, correct? Keep the diagram, you'll understand. A has given this loan to B at 6%. So A will receive from B interest. A will receive from B. A will receive from B 6% of 2 crore 40 lakh. 6% of 2 crore 40 lakh. 6% of 2 crore 40 lakh. Come on. 14 lakh 40,000 yen. But A has also taken loan from B $2 lakh at 9%. So you will write A will pay to B. A will pay to B 9% into $2 lakh. This will give you dollar value, but we have to convert into yen. So multiply by 120. 21 lakh 60,000 yen. So now you tell me the net total of this first 3 lines. Net total, net amount paid in yen. Net amount paid in yen, A plus B plus C. No, 1 is negative also. 2 positive, 1 negative. Sorry, 2 negative, 1 positive. This is negative, negative. This is positive, the middle one. So 19 lakh 20,000 yen will be the outflow. Now what is its equivalent amount in dollar? Point number E, write down equivalent amount in dollar. Point number E, write down net amount paid in dollar equivalent. Net amount paid in dollar equivalent. Net amount paid in dollar equivalent is 19 lakh 20,000 divided by 120. $16,000. Okay. So what it is effectively paying $16,000 with the help of swap. Suppose A would not have entered into swap. It would have directly borrowed $2 lakh from the market. What is the interest rate applicable to A for dollar loan? 9%. Interest rate payable by A on its own. Can you see in the first line of the table, A in dollar loan 9%. It would have paid to the market without swap $18,000. 2 lakh into 9%. 2 lakh into 9%. $18,000 without swap on its own. But with swap, it is paying $16,000. So what is the gain to A? One student, Mr. Rishabh, has answered gain to A is $2 lakh. 2000, sorry, 2000 is right. This is the correct answer. Okay. And now I am going to give you a small classwork. You have to write down the answer in the similar manner and calculate the gain or loss to B. So I'll give you 30 seconds to write the answer. I'll just come in 30 seconds. Please complete. Have you completed? Check the answer now. First you write down interest paid by B to bank. B has borrowed in dollar. So first B will pay interest to its bank 2 lakh into 10% 20,000. Then B will receive interest from A 2 lakh into 9%. B will receive interest from A 2 lakh into 9%, 18,000. Then B will pay interest to A at 6%, 2 lakh into 6%, 12,000. All calculation first we will do in dollar. Are these three lines understandable? And then you take the net total, minus 20 plus 18 minus 12 is minus 14,000. And this is in dollar. So I will convert into equivalent yen. Net amount in yen. Net amount in yen. Yen 16 lakh 80,000. Now suppose B goes to the market on its own and does not enter into a swap. The interest rate applicable to B on a yen loan is 8%. So B would have paid, Cabra is right, 2.4 lakh gain to B. Very good, Cabra. So very good to all the students who have replied. Sidana is also right. 2,40,000 yen. Gain in yen. 2,40,000. Now if you present like this, you'll get full marks. I also know the shortcut. Somebody will say why you have done so much. You can just write 1% of 2 lakh, 1% of 2 crore 40 lakh, and the answer is same. Yes, you are right. Shortcut answer is same. If it was an MCQ question, do like that only. So this was my question number 1. One more question number 2 also will solve today. Those who have completed, I request you to read the question number 2. Read question number 2, those who have done. Okay, now we'll go to question number 2. This question was asked in RTP some years ago, but still important. Two companies AS and XY face the following interest rates. This is a question on interest rate swap, okay. The previous one was a question on currency swap. Name of these two companies. AS, similar question but little different also. AS Limited can borrow US dollar floating rate at LIBOR plus 0.5%, whereas XY company can borrow LIBOR plus 1%. Canadian fixed rate, suppose they want to borrow Canadian dollar, fixed rate of interest. Fixed rate means interest rate will remain 5% for the entire tenure of the loan. AS will have to pay 5%, XY will have to pay 6.5%. Again my question is, who is a stronger party? Who has an upper hand? Is AS Limited stronger or XY Limited is stronger? Quickly reply. Quickly reply. I can't wait so much. AS Limited, because on fixed rate also it has to pay less interest, and on floating rate also it has to pay less interest. So AS Limited has got an upper hand. Okay. So how much is the benefit here? Just understand, the AS Limited has an upper hand by 0.5% here, and here it is 1.5%. Wait, I'll change the color. On floating rate 0.5%, on fixed rate it has an upper hand of 1.5%. Okay. Now it says AS Limited wants to borrow US dollar at floating rate, and XY Limited wants to borrow Canadian dollar at fixed rate. So AS Limited wants floating. XY wants to borrow Canadian dollar at fixed. So if on their own, if they borrow, these are the rates applicable to them. But we have to check, can we enter into swap and gain something out of it? A financial institution is planning to arrange a swap. These two parties are in two different worlds. They don't know each other. So how do they enter into such transaction? So they are usually through an intermediary, a broker, which are usually big banks who arrange the deal and they get a commission. So financial institution is planning to arrange a swap and requires a 50 basis point spread. 50 basis point spread means underline 0.5%. 100 basis point means 1%. So they say I will get a cut of 0.5%. I will arrange the deal, but then I should get 0.5% commission. If the swap is equally attractive to AS and XY, equally attractive means both should gain equal percentage. What rate of interest will AS and XY end up paying? So what is the effective rate of interest they will end up paying? That is the question. So what will happen? AS will borrow at first fixed rate and XY will borrow at floating rate. Okay. In order to have a swap, they will take an opposite position first. AS Limited wants to borrow at floating rate, but then it will borrow at fixed rate. XY Limited wants at fixed rate, but it will borrow at floating rate. So what will be their gain or loss here? Instead of XY, AS borrows at 5%, so they will gain 1.5%. Instead of AS Limited borrowing at LIBOR plus 0.5, XY will borrow at LIBOR plus 1, so they will lose 0.5 here because XY has to pay a higher rate. But still, if I compare, they will together as a gang get 1% benefit. AS Limited will borrow at 5, transfer to XY, so they will get benefit of together 1.5. XY will borrow at LIBOR plus 0.1, LIBOR plus 1, give it to AS, who would have paid LIBOR plus 0.5. So in floating rate, together they are losing 0.5. In fixed rate, together they are gaining 1.5. Net gain 1 and commission is 0.5. So effectively, still they will get 0.5% benefit. Okay. This 0.5% benefit, they will share equally. This will go to financial institution. 0.25 benefit goes to AS and 0.25 benefit will go to XY. Right? So first what I'll do, if you are interested, I will dictate you a small note on interest rate swap. Write down. One day before the exam, you can just quickly read it, just few lines only. Heading, write down interest rate swap. In interest rate swap, the two parties swap the interest obligation. One swaps the fixed interest obligation, other party swaps its floating rate obligation, such that both parties are benefited. Okay. Principal is not exchanged. Only the interest is exchanged. That is called interest rate swap. And whether interest rate swap is possible between two parties or not, I will give you a note for that. Whether interest rate swap is possible or not. Write down. Point number 1. Point number 1, write down. A switch from it is better to write in the notebook. A switch from fixed to floating rate is possible. A switch from fixed to floating rate is possible. That is what we are doing right now. Fixed to floating. The strong company AS will borrow at fixed rate and swap it with floating rate. Only if the difference in the fixed rate available to the two parties, only if the difference in the fixed rate available to the two parties is greater than the difference in floating rate available to the two parties. In our example, difference in fixed rate is 1.5% and difference in floating rate is 0.5%. So swap is possible between AS Limited and XY Limited. Next line, write down. This is our question number 2 on this point. This we don't have a question on this, but write down for your exam. A switch from floating to fixed rate is possible. A switch from floating to fixed rate is possible only if the difference in floating rate available to the two parties is greater than the difference in fixed rates available to the two parties. That means if the strong company first borrows at floating rate and swaps it with the fixed rate, the difference in the floating rate should be more than the difference in fixed rate. Then the swap is possible. And you should know the swap properly, because in your financial reporting subject also, Ind AS 109 financial instrument, there are questions on accounting of interest rate and currency swap. So this knowledge will be required in FR topic financial instrument. Now write down next line. Note, write down point number 1 and 2 above. Point number 1 and 2 above apply to the strong company. Point number 1 and 2 above applies to the strong company. Point number 1 and 2 above applies to the strong company. That is, write down little fast. In case of one above, point number 1 above, the strong company should desire to move from fixed rate to floating rate. The strong company should desire to move from fixed rate to floating rate. And in the case of 2 above, 2 means point number 2, and in the case of point number 2 above, the strong company should desire to move from floating rate to fixed rate. Strong company should desire to move from floating rate to fixed rate. So sometimes the question is whether a swap is possible or not. So to check whether the swap is possible or not, apply this test. If this test is successful, swap is possible. Otherwise, swap will not be possible. Now write down steps involved. Steps write down. Steps write down. Compute the difference in fixed rate. Compute the difference in fixed rate and difference in floating rate available to the two companies and difference in floating rate available to the two companies. Now write down compute the net difference. Compute the net difference. Compute the net difference. I have already explained. Step 3. Split the net gain. Split the net gain between the strong and weak. Between the strong and weak in the agreed ratio. In our example, the agreed ratio is 1:1, equally. Okay. Both parties should gain equally from the swap deal. And point 4, which is applicable in our question, intermediary. If an intermediary is involved, the net gain should be arrived. The net gain should be arrived after deducting the commission. Okay. If intermediary is involved, the net gain should be arrived after deducting the commission. Now, in some question you will get in the exam, intermediary is not given. Then ignore that. If intermediary is not given, ignore that. Written the note. Now write down the answer, just 2 more minutes. Step 1, calculate the net difference. Calculate the net difference. Step 1, calculate the net. From here the answer starts. So this will be your starting point in the exam. Okay. Previous few lines I have dictated for understanding purpose. Draw 4 columns. Particular column, AS Limited, XY Limited, and difference. Particular, AS, XY and difference. First write down fixed rate. Look at the question. What is the fixed rate applicable to AS Limited? 5%. Very good. What is the fixed rate applicable to XY Limited? 6.5. So if AS Limited borrows at 5% instead of XY, they will gain 1.5%. They will gain 1.5%. Write down gain 1.5%. Now write down floating rate. AS Limited can borrow at LIBOR plus 0.5. L stands for LIBOR. L stands for LIBOR. And XY will borrow at LIBOR plus 1. XY will borrow at LIBOR plus 1. So instead of AS Limited, if XY borrows, there will be a loss of 0.5%. There will be a loss of 0.5%. So what is your net difference? Net difference is still positive 1%. Say yes. So gain will be 1%. But between the two companies, there is an intermediary involved. Intermediary will also get 0.5% commission. So less commission to financial institution. Less commission to financial institution. 0.5%. Now my question to all of you is, what is the net gain? 0.5. Come on, reply. Net gain, net saving to both the parties. 0.5. This is what is the net gain. and then according to the agreed ratio they will have to share this net gain. Agreed ratio is given equally in the problem, somewhere equally attractive written. Can you see equally attractive? Which means both party will share equally. Step number 2 heading write down. Step number 2 heading write down, split the gain. Split the gain. Split the gain. So under that write down AS Limited will get 50% of 50%. 50% of 0.5. So how much will AS Limited gain from the swap deal? 0.25%. And how much XY Limited will gain? Same. If any other ratio is given, follow that. If nothing is given, equally. If equally is given, then also equally. But if other ratios are given, follow that. The answer is not over. What is the effective interest rate? What is the effective interest rate applicable to AS and XY? How much AS Limited would have paid on its own? US dollar floating rate LIBOR plus 0.5. But they will save 0.5. So effective rate will be LIBOR plus 0.5 minus 0.25. And what is the effective rate to XY? It would have paid 6.5 minus 0.25 now. The effective rate applicable to other company will be 6.5 minus 0.25. Write down step 3. Last step. Last step. Effective interest applicable to each party. Effective interest rate applicable to each party. AS Limited would have paid on its own LIBOR plus 0.5. It is saving 0.25 in the deal. So therefore effective rate is LIBOR plus 0.25. Effective rate is, one student has replied already, very good. LIBOR plus 0.25 is right. And XY Limited on its own would have paid 6.5. Saves 0.25. Saves 0.25. So what is your effective rate? If you would have paid 6.5 but you are saving 0.25, the swap deal is beneficial to you. 6.25%. So this is the final answer. And for this much effort, you will get 4 to 8 marks. This can be a question for 4 to 8 marks. Similar questions have been asked in the exam also. Okay, with different number, different currency, but the answer is same. Now we'll come to question number 3. Should we solve? Say yes or no. Yes? Okay. Question number 3 we will solve today. Are you ready? Say yes. Students at home, are you ready for question number 3? Everybody should say yes, then I will go ahead. Yes. Most students have said yes, so I will go. One more question will take, it is a small question, it will take 10 minutes. A Limited is to borrow euro 1 million for a period of 3 months after 24 months from today. So what A Limited wants to do, it is planning to borrow 1 million euro for how many months? 3 months. But when it will borrow? After 24 months, that is after 2 years. So it is worried that in future interest rate may rise. If you are planning to borrow money, then you are worried that interest rate may rise. So they want to hedge this risk. How do you hedge this risk? It enters into a 24 into 27 FRA. FRA means forward rate agreement. FRA means forward rate agreement with agreed interest of 5%. That means they will lock the interest rate at 5%. Now they can sleep peacefully. Whatever may be the interest rate after 2 years, they will effectively be paying 5% only. Is it right? After 24 months, now 24 months have passed, the 3-month interest rate is 5.5%. Oh my God. The interest rate has gone up. The interest rate has gone up. But don't worry. You are going to effectively pay at the rate of 5%, and that is what I am going to prove. So explain the cash flow on account of FRA. So by taking FRA, how much gain or loss you will have? How much gain or loss you will have? So tell me whether you will have gain or loss. Option A, gain or loss. Because the rate of interest has gone up, the other party, the counterparty, will give you the difference. The counterparty will give you the difference equal to 0.5%. Is it right? So A Limited will gain. A Limited will gain. Next line, what will be the amount borrowed by the company for a period of 3 months after 24 months from today? So how much amount you need to borrow? How much amount you need to borrow? You require 1 million euro minus the amount received from FRA, because FRA will give you some amount. Suppose I get 10,000 rupees gain, then I don't need to borrow 1 million. I will borrow 1 million minus 10,000, because 10,000 already I have got it. Right? So this is the amount I will borrow, and what amount will be paid by the company 27 months from today? Amount borrowed plus interest at the rate of 5.5% for 3 months. Amount borrowed plus interest at the rate of 5.5% for 3 months. So that is the amount you will pay. So I am going to prove that yes, by using FRA, the company will effectively paying at the rate of 5%. What I have to prove? The company will end up effectively paying at what rate? 5%. Write down one note first. Some students have asked what is 24 into 27. So write down a small 2-line note on that. Write down 24 into 27 FRA is pronounced as 24 by 27. And how do you interpret it? How will you interpret it? It means that, first you write, then I'll explain again. It means that the interest rate for 3 months, it means that interest rate for 3 months, how this 3 has come in this picture? 3 is the difference between 27 and 24. After 24 months, interest rate for 3 months after 24 months. It means interest rate for 3 months after 24 months. Suppose this is the timeline. This is today. This is 24 months. This is 27. So this is the gap. 3 months. This is the point at which you want to borrow for 3 months. You want to borrow at this point for 3 months. Is it right? So that is written as 24 by 27. Borrowing at the end of 24 months for a period of 3 months. Otherwise, the student will interpret borrowing after 24 months for 27 months. No, it is only for 3 months. That is from here to here. Next line, write down answer. This is the answer now. In the exam, you start from here. A Limited suffers loss. A Limited suffers loss on account of interest rate increase, correct? A Limited suffers loss on account of interest rate increase. This loss will be compensated by the bank. This loss will be compensated by the bank because the interest rate has gone up. You have entered into an FRA, so you are protected from the rise in the interest rate. Now the next question is, how much amount is payable by the bank to A? Anybody who would try this answer? If you have solved question of FRA in your classes, you will be able to answer how much is the amount that the bank will pay to A Limited today. How much amount bank will pay to A Limited today? So what is the notional principal amount here? The notional principal amount here is 1 million, and the bank will compensate you 0.5% for 3 months. For 3 months. But that amount was payable after 3 months. Bank is going to pay you today. So bank will pay you the present value of that amount. Bank will pay you the present value of that amount. So I will tell you how to do it. Very easy. First you write the amount the bank has to pay to A, 10 lakh, into difference between the interest rate in the market after 3 months minus the contractual rate 5% into 3 by 12 divided by, now this is the amount, but this amount is paid now. So we have to compute the present value. So present value will be 1 plus 0.055, this is the annual interest rate, into 3 by 12. Into 3 by 12. You will take the interest rate after 3 months for present value calculation. Yes, because after this date the interest rate in the market is 5.5%, and only then your final answer will match also. So one mistake students can make here is they can take 5% here. You have to take the market interest rate after 3 months. Yes, please calculate an answer. Student will say that I will only give you the answer every time. I want answer from you. You should answer. One student has replied 1233 euro. Very good. Amazing. So A Limited will get 1233 euro from the bank today. Today means at the end of 24 months. This is 24 months. So 1233 euro will be compensated to you by the bank. You need 10 lakh euro. This you have already received. So you don't need to borrow 10 lakh now. You can borrow lower amount. 10 lakh minus 1233. So write down below, after 24 months from today, A Limited will borrow euro 998,766.95. Now how did you get that magic number? In bracket write down calculation, that is 10 lakh is what you wanted to borrow. 1233.05 you got from the banker as a gain on FRA for 3 months. You'll borrow for 3 months and you'll borrow from the market at 5.5%. So this was your question. How much amount he will borrow after 24 months? Another question is how much amount will be paid after 27 months. Right. Please write after 27 months from today. After 27 months from today, A Limited will pay on maturity. A Limited will pay on maturity. This is your principal amount and this is the interest factor for 3 months. How did you get 0.055 into 3 by 12? So that is 0.01375. So you will write directly. Otherwise you can just apply the simple interest and get it. Yes, Rishabh, please reply final answer. Final answer. Anybody getting 10,12,500? The final answer is 10,12,500. This is the amount you will pay along with interest. 10,12,500. Now I am going to prove that you have paid effectively at the rate of 5%. So write down cross check. Effective interest paid. Cross check effective interest paid. How much you paid? 10,12,500. Suppose you would not have entered into FRA. Suppose you would not have entered into FRA. You would have borrowed 10 lakh. If you would not have entered into FRA, you would have borrowed 10 lakh. Divide by 10 lakh. Divide by 10 lakh into 12 by 3. Just for annualization purpose. So you have paid 10,12,500, which is effectively you are paying at the rate of 5% per annum. Had you borrowed 10 lakh at 5% for 3 months, you would have paid 10,12,500, which you are paying now also with FRA arrangement. But had you not taken FRA, then you would have paid 10 lakh plus 5.5% without FRA. It would have been higher. But by taking FRA, you are able to lock the figure. This figure gets locked. Come whatever may be the interest rate after 24 months, your final outflow after 27 months will be 10,12,500 only. Is it right? So this is the advantage of FRA. FRA can be used for hedging purpose like in this example. FRA can be used for just speculation also. FRA can be used for arbitrage also. Like any derivative product, there are 3 usage: hedging, speculation, and third, arbitrage. Is it right? So today we'll stop here. I'm just going to make a small announcement that we are going to conduct a test series on FR and SFM on our portal also, Vinod.in, and our app also, the current app which we are using, Vino. The paper I am going to set, and I am only going to check the paper, not by hiring some intermediate or final student who are usually checking the paper of other test series classes. Is it right? So the fees for each paper would be 600 plus GST, and there are 4 papers for SFM and FR. So you can either appear in 1 paper or 2 or 3 or 4. You can appear anytime, any day, anytime, no sequence, whichever paper you want. Okay, you will write the paper, take the photo, make the PDF and upload on the website or on the app, or you can email to us and I will check the paper. I will give you the feedback. I will write the comment. I will tell you where you need to improve. I have found that this test series, if conducted properly by a proper teacher and also checked by the teacher who is actually taking that subject, teaching that subject, it will be more effective. The reason why I have decided to check the paper for my student is I want them they should know where they can improve. What is the only difference between other test series class and our? I am going to check the paper, I am going to set the paper, and I am not going to just mix and match the question paper of last few years. I am going to give you new question also which have not been asked in the past exams. There may be one or two repetitions, but many questions would be such that they will be new type of question so that you will feel the exam pressure. Understood? So those who are interested can join our test series for final FR and SFM. It is a 100 marks paper. Format will be same as the institute. I will check the paper myself. I will take only limited number of paper because there is a limited time availability. Per day, suppose I take 1 hour to check one paper, maximum 10 to 12, 14 paper I can check. So therefore, please share this information with your friends also. Tell them that Vinod Kumar Agarwal sir himself will sit and check the paper, and we are only going to entertain limited number of papers. Once I find that I have received some 100, 150 papers, then probably I will stop taking more papers for correction because then I will not have time. I won't be able to deliver to you your answer sheet on time. Normally I will try to check the paper in 3 to 4 days only. But the maximum limit I am committing is 7 days. But 7 days is too much. Normally I will try to complete it in the same day, next day, 2 days or 3 days depending upon the volume. Right. In case if you have any doubt or query, you can ask me. You can email to us on our email ID asfoundation1@gmail.com, asfoundation1@gmail.com, or you can WhatsApp on 97669 21860. WhatsApp or call on this number. Please store this number because anytime you want to ask me any doubt, you can either send a mail or you can just simply ask on the WhatsApp. Okay, for any doubt of PA Final FR SFM, I am there with you. Don't worry. Any institute material answer which you have not understood, ask me. Any RTP, MTP answer which you have not understood, ask me. So thank you very much. I will meet you tomorrow, same time, 9:30. So today we'll take one more question on over the counter derivative. Please come to question number 4. Question number 4 is based on equity swap. A new type of question, you may or may not have done it before. So question number 4 is like this. CMT pension fund has a portfolio of shares of diversified companies valued at rupees 800 crore, enters into a swap arrangement with Boom Bank on the terms that it will get, underline, it will get 1.5% quarterly on notional principal of rupees 800 crore. So you will get 1.15% on a notional amount of 800 crore quarterly in exchange of return on portfolio, which is exactly tracking the Sensex, which is presently 43,200. So this will be swapped against Sensex return. This company CMT pension fund will pay Sensex return and will receive a fixed rate of 1.15%. So if it has to receive more and pay less, the difference will be received. But if it has to pay more and receive less, the difference will have to be paid. Okay, so we have to compute two things every quarter. We have to compute this amount, which is a fixed amount, but we have to compute the Sensex return every quarter. Sensex return every quarter will be the change in the Sensex divided by the base. The change in the Sensex divided by the base. So Sensex at the end minus Sensex at the beginning divided by Sensex at the beginning will give you return on the Sensex. You are required to determine the net payment to be received or paid. Very easy question once you solve it and once you practice it. This question is from October 2021, MTP for 6 marks, and it was asked earlier also. And these are the different Sensex values given at the end of each quarter. Sensex turns out to be 1, 2, 3, 4. So 4 calculation you will have to show. Would you like to try and tell me in the first quarter, how much amount will be received or paid? In the first quarter, how much amount will be received or paid? Anybody wants to try? In the first quarter, how much amount will be received or paid? This is the amount to be received. You have to compute the amount to be received or paid on Sensex. Anybody who wants to reply? Okay. So now I will try, but first I will give you a small note. Would you like to write the note? Say yes or no. Note on equity swap. Note on equity swap. Write down a small note first. Write down a small note. The above question is based on equity swap. The above question is based on equity swap. The above question is based on equity swap. Then write down, suppose they ask you a theory question. So tick mark for a 4-mark theory question also. Tick mark for a 4 marks theory question. Equity swaps. Equity swaps are derivative contracts. Equity swaps are derivative contracts between two parties. Equity swaps are derivative contracts between two parties that involve the exchange of future cash flows. With one cash stream determined on the basis of equity based cash flow, that is your Sensex basically in our problem, as return on equity index. One cash flow will be calculated based on movement in the Sensex, while the other cash flow stream depends on fixed income cash flow, which is 1.15% in our example, while the other cash flow stream depends on fixed income cash flow like LIBOR. Okay. So after writing this note, we will solve the question. The question is very easy. You have to compute how much amount is payable due to change in Sensex, how much amount is receivable, the difference between the two will be received or paid. So you have entered into a swap contract that you will receive a fixed income of 1.15% on a notional amount of 800 and you will pay the return on Sensex. So now we'll write down calculation of net payment to be received or paid. Presentation is equally important. Calculation of net payment to be received or paid. Calculation of net payment to be received or paid. Calculation of net payment to be received or paid. First you draw one table. Write down table heading. First write down heading quarter. Second write down Sensex. Which is given. Only the main calculation here is Sensex return. What is the increase or decrease in Sensex in percentage? Then we'll calculate column number 4, amount payable. This is what this company has to pay. Column number 5 is income receivable. Column number 5 is income receivable. Fixed income receivable. And the last column is net amount. 5 minus 4. Column number 1, 2, 3, 4, 5 and 6 is equal to 5 minus 4. 5 minus 4. If positive is receivable and if it is negative then it is payable. So this table will help you to understand the answer easily. Have you drawn the table? Say yes or no. So first year 0 or quarter 0, the Sensex is today 43,200. That is the base for calculating the return at the end of quarter 1. Quarter 1 Sensex is 43,720. So your Sensex return will be closing Sensex minus opening divided by opening. Closing minus opening divided by opening into 100. Calculate and check. Is it right? 1.2037%? Yes. Is it right? 1.2037%? Okay. So you will pay 1.2037% of notional amount 800. So now you will write here 800 into 1.2037%, which is 9.6296. This is payable. And receivable will be 800 into 1.15%. This will be every time the same calculation, 800 into 1.15%. So you have entered into a swap. You will pay swap based on Sensex return. You will receive cash flow based on a fixed return. So what is the receivable or payable in the first quarter? Please answer. What is the receivable or payable in the first quarter? 5 minus 4. Receivable is less, payable is more. Anybody wants to reply? Come on. The answer is payable. 0.4296. The answer is payable 0.4296. Is it right? 0.4296. Now you try the second quarter. Very good, Rishabh. Second quarter Sensex is 43560. 43560. Calculate the percentage. 43560 minus previous one 43720 divided by 43720. So this time there is a negative return. This time there is a negative return 0.3660. 0.3660. So you will take 0.3660 percentage into 800, negative amount you will get. So don't worry, negative is also possible because Sensex can go up or Sensex can go down. So minus 2.9280 approximately minus, and you are supposed to receive 9.20. Same calculation, I am not repeating. So 9.20 minus, again minus will become plus. This is already minus. So tell me the answer in the last column. Yes, please reply. Garg, please reply. Answer in the last column. It will be 9.20 plus 2.9280. So that is 12.1280. 12.1280. Very good. Come on, next. Quarter 3. Sensex is 44160. 44160. Priyanka is right. Very good. Now, student will complete Sensex quarter 3 figures and complete quarter 4. I will check the answer afterwards. Siddhana is right. Very good. Come on, next. What is the Sensex return in third quarter? Sensex return in third quarter is positive 1.3774%. So you will pay 1.3774% into 800. This percentage into 800. 11.0192. Very good. Cabra, very good. Next, 9.20 receivable. In the third quarter, you will pay the difference. Receivable is less, payable is more. So you will pay the difference. 1.8192. 1.8192. Now come to fourth quarter. Fourth quarter 43920 Sensex. Take the difference in percentage. Take the difference in percentage. So you are getting 0.5435%. You are getting 0.5435% negative minus 0.5435% into 800. Amount payable is minus 4.3480. So student will now reply, what is the net receivable in the last quarter? Waiting for your answer. Net receivable in the last quarter. Net receivable in the last quarter. So Rishabh has answered 13.54. Very good. 13.54 receivable. Very good. Amazing. So this way you will solve this question. This was a question on equity swap. Mark important. Something new to learn here. Now we'll go to question number 5. Another highly repeated question is question number 5. Very, very important. Highly repeated. So this question you have to do it before you go to the exam because it keeps repeated. This is the question I have taken from November 21 RTP, but similar questions have been asked in the past exams. So can we start now? Question number 5. Can we start? Okay. Derivative bank entered into a swap arrangement on a principal of rupees 10 crore. So one party will pay 10 interest on 10 crore and agreed to receive MIBOR overnight floating rate for a fixed payment on the principal, and it will receive interest which will be based on MIBOR overnight floating rate. MIBOR overnight floating rate. So this is a question of overnight index swap. In short, we will write OIS, overnight index swap. The swap was entered on Monday, 19th August 2019 and was to commence on 20th August 2019 and run for a period of 7 days. Respective MIBOR rates for Tuesday to Monday were 8.15, 7.98, 7.95, 8.12, 8.15, 7.75. So in case of floating rate, the interest is calculated on a daily basis. Based on whatever is the rate available on that day, interest will be calculated on a daily basis and on compounded basis also. Fixed rate is 8%. Fixed rate is 8%. Then evaluate the nature of this swap arrangement. This kind of swap is called overnight index swap. And the net settlement amount. The net settlement amount will be the difference between the amount payable and the amount receivable. Sunday is a holiday only in the question. Okay. Sunday is holiday in the question. Consider 365 days in a year for interest calculation. So can we start now? You will say yes or no. Can we start? But first I will give you a small note on overnight index swap. Note, write down for 4 marks. Suppose the theory question is write a note on overnight index swap. So with the theory we will understand the concept also. It will serve two purposes, theory and practical both. So write down note. The given swap arrangement is plain vanilla overnight index swap. The given swap arrangement is plain vanilla. One party will pay fixed rate, other party will pay at floating rate. It's plain vanilla overnight index swap. In short, write down OIS. OIS. Every time you don't have to write overnight index swap, you can write OIS. Now next line write down. Next line, OIS is an interest rate swap involving a fixed rate being exchanged for an indexed rate. A fixed rate exchanged for an indexed rate like LIBOR or MIBOR. What is the meaning of MIBOR? If you want to write Mumbai Interbank Offered Rate or Treasury Bill Rate. So floating rate will be linked to either LIBOR, MIBOR or treasury bill rate. Next paragraph. In an OIS, one of the institutions is swapping overnight floating interest rate and the other institution is swapping a fixed short-term interest rate. It's swapping a fixed short-term interest rate. So one party will be paying floating rate, the other party will be paying fixed rate. But this is for a very short period, like few days. In our example, it is only for 7 days. So sometimes it is for 7 days, 10 days, like that. Now how is the interest calculated? Write down. Very important for solving the question. So next line is the interest is computed on a notional principal amount. Principal will not be exchanged. Only the interest will be exchanged and it will be calculated on a notional principal amount and settled on a net basis at maturity. So the one who will receive more will get the net difference and the one who has to pay more will pay the net difference. Next line, last line for the note. On the floating rate side, this is important. The interest amounts are computed on a daily basis on the index. The interest amounts are computed on a daily basis on the index. The interest amount are calculated on a daily basis on the index. Okay, have you written? All of you have written. So can we now go to the answer? Now in your exam the answer will start from here. You don't have to write the note unless they ask you to explain what is OIS. So let us write down. Calculation of net settlement amount. This is my question. What is the net settlement amount? So I need to first calculate the interest under floating rate. That is the main calculation. Fixed rate is simple. So student will write now, calculate interest as per floating rate. Calculate interest as per floating rate. Draw this table with 4 columns. First column write down day, then write principal, then write MIBOR percentage, then write down interest in rupees. Now first you start with Tuesday. Because you entered into contract on Monday, so the calculation will begin from Tuesday. Tuesday the principal amount is 10 crore and the first interest rate given is 8.15%. 8.15%. So how will you calculate interest here? You have to calculate interest for only one day. 10 crore. Type 10 crore into 8.15% into 1 by 365. Into 1 by 365. Please reply. One student has replied 22,329. Very good. Wednesday. Now Wednesday the principal amount will be principal plus interest. It will be calculated on compounded basis. So my principal amount will be 10 crore plus 22,329. 10 crore 22,329. And what is the interest rate given here for the next day? 7.98%. Again calculate. For one day, take this amount into 7.98% into 1 by 365 into 1 by 365. Answer please. Just for one day you have to compute interest. So the answer is 21868. Very good, Rishabh. 21868. Thursday opening principal will be this amount plus 21868 plus 21868. So 10 crore 44,197. Okay, come on. Interest rate 7.95%. 7.95%. Multiply and into 1 by 365. The answer for Thursday is 21790. Very good. Come on, next. Friday. Take the total of these two. This is the opening balance for Friday. 10 crore 65,987. Interest rate 8.12%. Come on. Friday interest. Interest for Friday. 22,261. Very good. 22,261. Now there is a problem. Saturday. And the note number 1 in the question is Sunday is holiday. So you will have to calculate interest for 2 days now. Saturday and Sunday. So this is important. If there is a holiday, you will calculate the interest for that day with the same rate. So now we'll take interest for 2 days when you do the calculation. So opening balance of principal will be, take the total of this number plus this number, 10 crore 88,248, 8.15%, multiply into 2 by 365, into 2 by 365, 44,697, 44,697, and the last calculation Monday, take the total of principal plus interest. The opening balance on Monday would be 10 crore 1,32,945. 7.75%. Calculate on Monday. Monday. 21261. Very good. 21261. Take the total of the last column. Total of the last column. Do it yourself. And then we will check. That is the total interest under floating rate. Total interest under floating rate. The answer comes to 154,206. 154,206. So this is the interest under floating rate. Any query on this? 1,54,207 is right. 154,207, 206, 154,206. Now I will write down total interest at fixed rate. Total interest at fixed rate. Total interest at fixed rate. You will take 10 crore into 8% into 7 days divided by 365 days. Fixed rate interest will be, anybody fixed rate interest will be 153,425. 153,425 is right. The student who have replied is right. So net settlement amount. Difference between step 1 and step 2. Anybody? Net settlement amount. Yes, come on. Net settlement amount will be 154,206 minus 153,425. So the answer is 781 rupees. 781 rupees. So this is you will receive, this is you will pay. So this 781 is the net gain. 781 is the net gain. So after 7 days you will receive 781 rupees. This is how overnight index swap works. So this was interest rate derivative. So we have taken many questions on interest rate derivative. Now we'll go to our next important topic where you will get one question for 8 to 10 marks, that is business and corporate valuation. Business and corporate valuation. So should we start business and corporate valuation, or do you want to take a break? Continue or break? So we will continue. We are the student. Okay, we want to pass with good marks. So I will go to question number 1. I will tell you honestly, this is one of the most repeated questions from this topic. And second thing, the easiest question on this topic. Anybody can do it. You can see the frequency of this question. June 2009 exam for 10 marks. Same question in November 2012, November 18 RTP, May 19 exam, July 21 exam. Okay. And September 22 MTP also. Yes, the party has just started. One student is saying party has started now. Okay. So question is, so I am going to take on this topic those questions which are highly repeated in the exam and which are very important. X Limited reported a profit of rupees 65 lakh after 35% tax. So this is PAT, 65 lakh. So profit before tax will be 65 lakh divided by 1 minus 0.35, which should be 100 lakhs. So profit before tax will be 100 lakhs. Very good. For the year 2007-8, an analysis of the accounts revealed that the income included extraordinary item rupees 10 lakh and extraordinary loss rupees 3 lakh. When you are doing business valuation, you should not take into consideration extraordinary income or extraordinary loss. Abnormal item should not be considered, because extraordinary or abnormal item will not be repeated in future. These are one-time event, one-off event, and they will not be repeated. So any extraordinary income that you get, you deduct, 10 lakh will be deducted, and any extraordinary loss will add back. So you will get your normal profit before tax, 100 minus 10, 90 plus 3. 93 lakh will be your normal PBT. We have to eliminate the effect of abnormal transaction when you are doing business valuation. The reason is this will not be repeated in future. The existing operations, except for the extraordinary items, are expected to continue in the future. Very good. So we expect this 93 lakh will continue in the future. In addition, the result of launch of a new product are expected to be as follows. And what they have done? They have undertaken a new project. So this new project will also bring more profit. How much profit the new project will bring? Take your calculator. Sale 60 minus material 15 minus labor 10, 60 minus 15 minus 10 minus fixed cost 8. So how much is that? How much is the additional profit from the new project? How much is the additional profit from the new project? Is it 27? Just check. I have just done without calculator. So 27 lakh. So my revised PBT will be 100 lakh. My revised PBT would be not 100, sorry, 120 lakh. My revised PBT would be 120 lakh. Is 120 right? Today I forgot to bring the calculator. So please help me. If you help me today, God will help you in the exam. So revised PAT will be 120 minus 35%. Anybody 120 minus 35%? 120 minus 35% will be the revised PAT in the future. 120 minus 35% will be the revised PAT in the future. So that will be equal to how much? 120 minus 35%. Anyway, please reply 78 lakh. Very good. Compute the value of the business given that the capitalization rate is 15%, which means the investor wants 15% rate of return. So how much are they willing to pay for this business? They will be willing to pay for this business equal to 78 lakh divided by 15%. How much they are willing to pay if they want 15% return? 78 divided by 15%. Yes, Garg, please reply. So they are willing to pay 520 lakh. That is what you have replied. 78 divided by 15%. So this will be your first answer. While talking only we have completed. Next is determine the market price per share. Per share means you have to divide by number of share, with X Limited share capital being comprised of 1 lakh 11% preference share of 100 each. So this was my PAT 78 lakh. I will have to deduct preference dividend first. If you have preference dividend, so preference dividend will be 1 lakh into 11% into 100. That is, I think, 11 lakh. So earning available to equity shareholder will be 78 lakh minus 11 lakh, 67 lakh. And how many shares are there? There are 40 lakh share. So you have to divide by 40 lakh share. You will get EPS. And P ratio is 8 times. So multiplied by 8 times. If I use P ratio for valuation, the answer will be P ratio into EPS. P ratio into EPS. So that will be the value per equity share. That was a very simple question. I have almost written the answer, but we have to write the answer nicely. We are a student. So question already explained to you. You must have done in the regular batches also. Please write. Very easy. We'll go little fast because most of you can easily do it. Only you have to take care you don't make silly mistakes. So write. Calculation of future maintainable profit and value of business calculation of future maintainable profit and value of business. I have started getting answer also. I will check it later. See, presentation in the exam is very important and that gives you full marks. I came in the rank in foundation inter-final. One of the reasons was the answers were presented nicely, so the examiner does not have the scope of deducting marks. Okay. So first you write down first point a PBT. As discussed earlier, the current PBT is 65 divided by 1 minus 0.35, which is 100 lakh. Then I will remove the extraordinary gain or loss. Extraordinary gain, remove, minus extraordinary profit 10, minus extraordinary profit 10. But if there is an extraordinary loss, it will be added back. Add back extraordinary loss 3. Add back extraordinary loss 3. So that this will give me the current PBT, normal PBT at present. That is called existing normal PBT, and to that I will add the profit of a new project. So write down point number D. Add additional income from launch of a new product. Add additional income from the launch of new product. Add additional income from the launch of new product. Under that write down, inner column you will write sales 60. Just don't take on calculator and write in the outer column. You have to present the calculation of additional income. Sales 60, material cost 15, labor cost 10, labor cost 10, less fixed cost 8. So this will give you 27. So my PBT now, PBT after new project, PBT after new project will be 120, 100 minus 10 plus 3 plus 27, 120. Less tax at the rate of 35%, 42. Less tax at the rate of 35%, that is 42. Therefore, PAT 78. So in future the company would be earning 78 lakh rupees, and the capitalization rate means the required rate of return from such business is 15%. The required rate of return from such business is 15%. So if a company generates 78 lakh of PAT and the required return from such business is 15%, what will be the value of the business? The value of the business will be 78 divided by 15%. 78 divided by 15%. How much is that? 78 divided by 15%. How much is that? That is 520. Very good. 520. Now tell me, if you write like this, where is the scope of deducting marks? This PAT figure I will require for my next answer. This PAT figure I will require for next answer. This is the value of the entire business. This is the value of the entire business, 520. Now they have asked you one more query. What will be the market price per equity share? What will be the market price per equity share because they have given P ratio also, the intention of the question setter is that the student must apply P multiple approach for valuation of share. As you know, value of equity share can be calculated under different ways. One method is P multiple approach, EPS into P ratio. So therefore, I will first find EPS and then multiplied by P ratio. That will give you market price. So write down calculation of market price per share, per equity share. Calculation of market price per equity share. Under that write down serial number, particulars, rupees in lakhs. First write down, as we have done in the earlier step, FMP, future maintainable profit after tax. This was step 1. Step 1, 78. Less preference dividend. Less preference dividend. Preference dividend will be 1 lakh preference share into 100 into 11%. That comes to 11 lakh. So PAT minus preference dividend is called earning available to equity shareholder. You will remember those happy days of accounting standard 20 EPS 67, and you have Ind AS 33 also EPS. Now write down divide by number of equity shares. Divide by number of equity shares in lakhs, 40 lakhs. Very easy. You must have done this calculation several times in intermediate also. EPS, up to EPS calculation, Mehul is right, 1.675. 1.675. P ratio is given 8 times. P ratio is given 8 times. P ratio is given 8 times. Therefore, market price per share is 13.40. Market price per share is 13.40. Mehul is right. Rishabh is right. This is called P multiple approach. This is called P multiple approach. So can we go to the next question now? Another highly repeated question is question number 2. It's a repeat question. They can ask in next exam also. Don't be surprised. Question number 2. May 2018 exam for, I think it was 8 marks, and similar question is in November 19 RTP, and it has been repeated in other exams also, other RTP and MTP also. So question is again very interesting question. Valuation done of an established company by a well-known analyst has estimated a value of 500 lakh. So they have already done the valuation of a company, and it is done by a well-known analyst. Okay, well-known analyst. This analyst name is Hinderberg. Okay, name of this analyst is Hinderberg, and they have done the valuation at 500 lakh. If you have a network issue, some students are saying network issue, just restart your laptop or computer or mobile again, because we can find that the network is right from our end. Okay. Then there was an well-known analyst. He has done the valuation of a company at 500 lakh. This company is Adani Enterprise. Okay. Based on the expected free cash flow for the next year of rupees 20 lakh. So what are the data given? I will tell you. The valuation is 500 lakh. Free cash flow of the next year is 20 lakh, and the expected growth rate is 5%. While going through the valuation procedure, you found that the analyst Hinderberg has made the mistake of using book value of debt and equity in its calculation. So what are the weights used? The weights used are based on book values. So this is a mistake. It should be based on market values. It should be based on market values. Next line. While you do not know book value weights he used, it means basically they are giving you a hint. The student has to find out what was the book value weight the analyst had used. You have been provided with the following information. What is the information? Good news for you. The cost of equity is already done for you, 12%. After tax cost of debt is already done for you, 6%. So the weighted average cost of capital is equal to weight of debt into cost of debt plus weight of equity into cost of equity. So you have to find out how much weight this analyst had used in the valuation of this firm using book value weights. Next line. The market value of equity is 3 times the book value of equity. So when you will do the calculation, you will take 3 into weight of equity based on book value weights, while the market value of debt is equal to book value of debt. But for debt you will take weight of debt will be equal to weight of debt only as per book value, but weight of equity will be 3 times the book value of equity. So my question is, for 8 marks, you are required to estimate the correct value of the company. This means you have to do the value of the company using market value weights. What will be the value of the company? Using market value weights, they have done calculation on the basis of book value. Book values are usually not reliable because they are based on historical values, whereas the market takes into account the current economic value of the firm. So it is believed that market value is a better way of assigning weight as compared to book value. So first chance to you. Question for you. What is the correct value of the company? I will give you 45 seconds to try. and I will give you 8 marks if you get it right. And then you will get a job in Adani Group company also. I want the final answer. What is the correct value of the firm? I want final answer. What is the correct value of the firm? The students are replying current cost of capital, current book value weights. You are right, but I want final answer. Keep trying, keep trying. You are on the right path. Keep trying. Other student will also try. So one student has replied 363.64. Let us check whether it is right or not. Let us check whether it is right or not. Any other student who wants to reply? So what we'll do, first we will calculate overall cost of capital used by the analyst. First we'll calculate overall cost of capital used by the analyst. For that we have to solve a simple equation. Write down step 1. Step by step you will get full marks. Don't write directly in the exam. On your calculator, don't calculate and just put the answer. Present it well. Present it well. Step 1, step by step gives you more marks. Psychological impact on the examiner that the student has written so many steps. Calculation of overall cost of capital using book value weights. So I have been given value of the firm, I have been given free cash flow of the next year, I have been given growth rate. So in this equation, if you really see, KO is missing. That is, overall cost of capital is missing. So I can solve the equation and find the value of KO. With practice, you can easily solve this question and you will get full 8 marks. With good presentation, you will get full 8 marks. So write down equation, value of the firm is equal to FCF divided by KO minus G. 500 equal to 20 divided by KO minus 0.05. So when you solve the equation, you will get KO is equal to 9%. This is based on book value weights. This is based on book value weights. Now write down step number 2. So this is our overall cost of capital, weighted average cost of capital. I have been given cost of equity, cost of debt. There are only two sources of finance, debt and equity. So if you assume one of them as, let us say, X, the other one will become 1 minus X, and therefore you have to deal with only one missing variable and solve the equation. So one more equation will have to solve to find the book value weight of debt and equity. Write down step 2. Write down step 2, calculation of weight of debt and equity. Calculation of weight of debt and equity. Calculation of weight of debt and equity. Just 1 minute, please. Okay, let us start again. There was some internet issue, but now it is resolved. So write down step number 2, calculation of weight of debt and weight of equity using book value weight. Using book value weight. let the weight of equity be WE. You can write X also, and weight of debt will be 1 minus WE. 1 minus WE. Weight of debt will be 1 minus WE. Correct? So therefore, the equation for overall cost of capital is WE into KE plus WD into KD. WE into KE plus WD into KD. Now I will give you the numbers. You will solve and give me the value of WE. Come on. KE overall cost of capital is 9%, 0.09. I will solve an equation 0.09. This is here. Weight of equity into cost of equity 0.12. Weight of debt into cost of debt is 0.06. Please solve and give me WE. Solve and give me WE. Solve and give me WE. Anybody solve and WE? So weight of equity is 0.5. Weight of equity is 0.5. And therefore the weight of debt will also be 0.5. 1 minus 0.5. Weight of debt will also be 0.5. Do you agree? So these are the book value weights. But the market value of equity is 3 times of the book value. So market value weight will be 3 into 0.5. That is 1.5. And market value of debt is equal to book value. So that will remain 0.5 only. Is it right? So write down step number 3. Step number 3, presentation is important. I am telling you calculation of market value weight. As per the question, the market value of equity is 3 times of book value. 3 times of book value. So that is 0.50 into 3. 0.50 into 3. 1.5. Market value of debt. Market value of debt. 0.50 into 1. 0.50 into 1 is 0.50. So total will be 2 now. And the proportion of equity will be 1.5 by 2. And the proportion of debt will be 0.5 by 2. Right. So use these weights and recalculate the cost of capital using market value weight. So write down again calculation of revised overall cost of capital. Calculation of revised overall cost of capital using market value weight. Using market value weight. Calculation of revised overall cost of capital using market value weight. So now write the equation again. KO is equal to WE into KE plus WD into KD. In case if you don't want to write the equation, write directly 1.5 divided by 2. You can see here above 1.5 divided by 2 is the weight of equity into 12 plus you can see above 0.5 divided by 2 into 6 is the weight of debt. So the answer is 10.5%. Rishabh is right. Very good. Now I am going to use this as a discount rate, this as a cost of capital for calculating the correct value of the firm. So now my answer is almost over. Step number 5. Step number 5. Calculation of correct value of the firm, calculation of correct value of the firm using market value weights, calculation of correct value of the firm using market value weights. Calculation of correct value of the firm using market value weights. So please answer what will be the answer of this question. What will be the answer of this question? Okay, we are just reconnecting. Please wait a minute. Okay, so tell me the answer of this question. Value of the firm is equal to free cash flow divided by KO minus G. Free cash flow divided by KO minus G. Free cash flow divided by KO minus G. 20 upon 10.5% minus 5%. So the answer is, one student has correctly replied 363.64 lakh. Very good, Rishabh. You will get 8 marks for this answer. 363.64 lakh. This question has been asked several times in the exam. Now one more question which is repeated from this topic is question number 3. See the frequency of this question. Originally it was asked in May 2010 exam for 10 marks. Then they have given in RTP 2012, November 2022 RTP, and it has been asked in May 22 exam for 8 marks. So you can't miss this question. Very important question, tick mark. Question number 3. Ready for solving this amazing question? Yes, I think similar question was in November 22 exam also. I think similar question was in November 22 exam also. So please do it carefully. Please practice it 2 times before you go to the exam. There are so much of data. How to use the data properly we will see. Following information are available in respect of XYZ Limited, which is expected to grow at a higher rate of 4 years. First 4 years supernormal growth. Growth rate will be high, which is 20%. After which the growth rate will stabilize at lower level, and then the growth rate will become 10%. Then the growth rate will become 10%. Last year or base year information. This base year means it is already happened last year. That will be taken as a base for next year calculation. So last year sale was 2000 crore, EBIT was 300 crore, capital expenditure was 280 crore, and depreciation was 200 crore. Information for high growth and stable growth period are as follows. Now read the problem carefully. This column is applicable for first 4 years, when the sales and EBIT will grow at the rate of 20%, capital expenditure and depreciation will grow at the rate of 20%, risk-free rate is 10%, equity beta is 1.15, market risk premium is 6. So this will help you to calculate the cost of equity. Pre-tax cost of debt is 13%. Pre-tax means before deducting tax benefit. And during this period, the debt equity ratio will be 1:1. So this information will help you to calculate the KO. And in the stable growth period, sales and EBIT will grow at the rate of 10%. Okay, this student is asking, this is already asked in the last two attempts. Can it be asked again? Same question last November exam also the student had asked me that it has been asked in May 22. So will it be asked in November 22? Yes, sometime hat trick is also possible. So why not to learn this question? So next is stable growth 10%. Then capital expenditure are offset by depreciation. So no effect of capital expenditure and depreciation. Now in the stable period, this data have changed. So we have to recalculate KE. We have to recalculate KD. We have to recalculate KO for the stable period. For all time, working capital is 25% of revenue. So this is important. Working capital at any point of time will be 25% of your sales. So sales into 25% will be working capital, and corporate tax rate is 30%. Tax rate for all calculation purposes 30%. Find out the value of the firm. So this is a two-stage growth model. First 4-year supernormal growth. So we'll prepare a table and then the growth will stabilize. So we'll apply the formula of growing perpetuity. And this problem will require you to calculate free cash flow available to the firm. Free cash flow firm approach. Free cash flow available to the firm. So I will have to write down the answer in step-by-step manner. You can see this question has come consecutively in 2 exams. There is no reason it can't be asked in the next exam with some different data or some minor adjustment, because this question is very fundamental question for business valuation, right? So are you ready for 8 marks? Once you say yes, then only I'll start. Are you ready? So write down. We will divide our answer into 2 phases. Phase 1 is explicit forecast period, that is first 4 year, when you can calculate the cash flows of individual year. And then from 5th year onwards, the growth rate will become stable at 10%. Okay. So write down first stage 1. You can write in capital letters. Stage 1 explicit forecast period, when you can calculate individual year cash flow. And you have to first do some basic calculation like cost of equity, cost of debt, KO. So first you write down step 1. K is equal to RF plus beta into RM minus RF. RM minus RF. Look at the question. Look at the high growth column. RF is 10. RF is 10. Beta is 1.15. Beta is 1.15. And market risk premium is 6. Market risk premium is 6. I want the answer from you. Student should reply. Yes, come on. What is the answer? For cost of equity, the answer is 16.9%. 16.9% is right. Very good. Come on, next. Mehul is right. Kabra is right. Step 2, write down cost of debt. Cost of debt, Rishabh is right. Check cost of debt, I into 1 minus 3. Now in the exam, be careful with the wordings. Pre-tax cost of debt is written. So you will get tax shield. In some earlier question, post-tax cost of debt was written. In previous question number 2, if you see, in previous question number 2, after-tax cost of debt was written. So we have taken that answer directly. But pre-tax cost of debt is written. The student has replied 9.1%. Very good. Siddhana is right. Amazing. Now you tell me what will be KO or WACC, overall cost of capital. I will give you the formula. You will give me the answer. WD into KD plus WE into KE. The problem in the last line says debt equity ratio is 1:1. 1:1 means 50% debt, 50% equity. So Priyanka has replied, she has given two answers, 14 and 13, which you want to finally lock. 13% is the right answer. Rishabh and Priyanka have given 13% right answer. Okay, 13 is right. Now what I'll do, I will compute the present value of the free cash flow of the first 4 years, and I will also find out what will be my terminal cash flow. That means the cash flow of the 5th year, because that will be required for the infinite period. So year 1, 2, 3, 4 individual year, and we have to also estimate the cash flow of the 5th year for that stage 2 infinite growth period. Write down step 4. Step 4. PV of FCFF. FCFF, free cash flow available to the firm. FCFF means free cash flow available to the firm. Step number 4, free cash flow available to the firm. First write down NOPAT, net operating profit after tax. Net operating profit after tax, that is called NOPAT. Net operating profit after tax. How do you calculate? You have to take the previous year EBIT into 1 minus T into growth in EBIT 20%. Previous year EBIT is 300. I will give you the first working. Into 1 minus 0.3, which is your tax rate, and the growth is 20%. Growth is 20%. So just take on your calculator. 300 into 0.7 into 1.2. 300 into 0.7 into 1.2. So are you getting 252? And then you just increase it by 20% in the second year. Increase by 20%, 302.4. Increase in the third year also by 20%, 362.88. Increase by 20% in the fourth year, 435.46. Wait, in the fifth year, the growth rate will be 10%. Can you see 10% stable growth? So what I have done, I have multiplied by 1.1, that is for 10% growth. This is your net operating profit after tax. Net operating profit after tax. Any query on this? No query? then I will write down capex less depreciation. Capex less depreciation. The problem says in high growth period, capital expenditure less depreciation will also grow at 20%. So go to the previous year. Previous year capex was 280 and depreciation was 200. Depreciation was 200. So 280 minus 200 into 1.20 will give you 96. And then you increase by 20%, 20%, 20%. Here I have written 0 because in the stable period, capital expenditure are offset by depreciation. Capital expenditure are offset by depreciation. So capex minus depreciation is 0. Capex minus depreciation is 0. In the stable growth period, capital expenditure and depreciation are equal. Third line, write down working capital. Last second line of the question. Working capital is 25% of the revenue. Working capital is 25% of the revenue. Now you understand the year 1. The revenue of the previous year is 2000, but growth rate is 20%. So the next year revenue will be 20% more than previous year and multiply by 25%. 2000 into 1.20 will be future sale into 25%. The answer is 600. Now go to next year. This will increase by 20%. 720, 20%, 864, 20%, 1036.80, and then the growth rate will be 10%. Write down nicely. Calculation also you can write if you want. Okay, so now we'll come to this is working capital required. Now this is the point of mistake. Student will just take this figure. You don't have to take this figure. You have to take the increase in working capital or decrease in working capital for calculating free cash flow. So I have to compare with the opening working capital and I will see how much additional working capital would be needed. So write down point number D. This is important. Students forget to write this line. Increase or additional working capital. Now last year working capital was 25% of 2000. Last year working capital was 25% of 2000 because last year sale was 2000. And this year working capital, coming year working capital requirement is 600, this 600 rupees. So I will have to invest 100 more. Same logic here. 720 minus 600, 120. 864 minus 720, 144. This minus this, 172.80. This minus this, 103.68. Write down nicely. This presentation helps you to understand better and we don't make mistake. Now this is my NOPAT. This is my additional capex required and this is my additional working capital required. Do you know the formula of FCFF? FCFF means free cash flow available to the firm. So that will be NOPAT minus this because the cash flow that we will get in our pocket will be after incurring capex and working capital requirement. So my next line is very important, FCFF. A minus B minus D. A minus B minus D. A, B and D. Try yourself. FCFF is NOPAT minus net investment. You are right. Net investment is capex minus depreciation plus working capital. NOPAT minus net investment is FCFF. And net investment is capex minus depreciation plus additional working capital. Very good. Check the answer. Once you say it is right, I will go to the next column, next line. Check the calculation and suggest me if it is right. Is the answer right? 56, 67.2. All are right. Very good. So I can go to the next line. Now I need to compute the present value of only the first four number. This is the first year of the normal growth period. It will grow forever at 10%. So only calculate the present value of the first 4 years. Present value will be at the cost of capital of the first 4 years, which is 13%. Write down PV at 13%. Take on your calculator. 56 divide by 1.13. Divide by 1.13. You will get 49.56. Memory plus. Year 2. 67.20 divided by 1.13 equal to 2 times, and memory plus 52.62. Year 3, 80.64 divided by 1.13 3 times equal to, you will get this number 55.88, memory plus, and then you take 96.77 divide by 1.13 4 times equal to, memory plus 59.32 is the fourth year. Take the total of these numbers or memory recall. If you have used the memory plus function, you will get 217.38. You will get 217.38. Is it right? 217.38. Total of the first 4 year is 217.38. Yes. Now I am going to calculate the PV of terminal value, but for that the data has changed. The cost of equity will undergo a change. The cost of debt will undergo a change. Overall cost of capital will change. So I need the basic calculation of KO again. Write down stage 2, capital letters. In capital letters, write down stage 2, stable growth. Stable growth. New cost of equity. New cost of equity 9 plus 1 into 5. 9 plus 1 into 5. Data has changed. So revised cost of equity would be 14%. New cost of debt. Cost of debt has also changed to 12.86. So it will be 12.86 into 1 minus 0.3. That is equal to 9%. Check. Is it 9%? So can you give me WACC now? WACC, that is KO. Please reply. What will be the revised KO from 5th year onwards? It will be based on new weights. Weights have also changed. 2:3. The weight is 2:3, means 2 by 5, 3 by 5. 2 by 5 means 40%. 3 by 5 means 60%. So the answer is, anybody? Yes, one student has replied 12%. Very good. So this will be the KO for normal growth, so stable growth period, 12%. So now I am going to calculate first terminal value, present value of terminal value, and then finally the value of the firm. Write down, next line, write down terminal value. Terminal value is equal to free cash flow of the 5th year divided by KO minus G. So we have computed this number 375.32 in the previous table. This is my new KO, 12%, and the growth rate is now 10% in the stable period. So the answer is, check, approximately 18750. 18750. But this is the value you will get at the end of 4th year. If you want to write, this is nothing but PV4, means the present value at the end of the 4th year, not today, because the infinite series will start from 5th year. Now write down PV of terminal value. PV of terminal value will be 18750 divided by 1.13 to the power 4. Do this calculation. You will get approximately 11,500. And the last part, value of the firm, will be stage 1 plus stage 2. Stage 1 plus stage 2. Go to your stage 1 answer, you will get 217.38. And this is stage 2 terminal value 11,500. So the final answer is 11717.38. 11717.38 is the value of the firm. We have written all the details. Okay. The purpose of writing in detail is that when you revise, you understand. When you write the answer in the exam, the examiner is also impressed that yes, you have written everything on step-by-step basis and you have not written anything directly. So this answer is over. One student, Rishabh, has got it right before everybody. Very good. Keep it up. Now we'll go to question number 4. Question number 4 was originally asked in November 2010 RTP. Then it was given in May 18 RTP. And it was asked in one of the exams also earlier, long back. This question is different from other questions. This question is different from other problems. Why? It is based on chop-shop approach. What is chop-shop approach? Breakup value approach. This method is used for diversified companies. The companies which are operating in multiple business segments, so each business segment is valued separately and then you add it. That gives you the value of the business. So I will read the question. I will give you a small note on chop shop approach. Then we'll solve. Are you ready? Are you ready? Say yes or no. Using the chop shop approach or breakup value approach, assign a value for Cranberry Limited whose stock is currently trading at a market price of euro 4 million. Now don't get scared by this euro. In this question there is no conversion involved. All figures are in euro. Some students have asked me in the past, is it a forex question? This is not a forex question, this is a valuation question. For Cranberry Limited, accounting data set forth three business segments. So there are three business segments here: consumer wholesale, retail and general center. Data of the three segments are as follows: segment sale, segment asset, segment income. These are the different bases for valuation. Some valuation is done on the basis of sales multiple. Some valuation are based on asset multiple. Some valuation are based on income multiple. Okay. So we are going to apply all the three bases of valuation. And then industry data for pure play firm. Sir, what is pure play firm? Pure play firm is the firm which is only into one line of business, only into wholesale business, only into retail business, only into general center business, and they have used the multiple of pure play firm that will be used for valuation of this company Cranberry. So they have gone to the stock exchange. They found that those companies which are only into wholesale business, their market capitalization to sales ratio, market capitalization to sales ratio is 1.18. Market capitalization to asset ratio, I think it is written sales upon capitalization in your book. My mistake. In your book, it is written sales upon capitalization. This was how it was asked in the exam. Asset upon capitalization and income upon capitalization. And these are the ratios they have given to you. Based on that, you have to do the valuation of this company. So how are you going to do the valuation? Kindly guide me. Kindly guide me. How do I do the valuation of this company? There are three segments. So I will have to value each of them separately. Under sales multiple, asset multiple, income multiple approach. So again I will get three answers. If I use sales as a base, I'll get one answer. If I use asset as a base, I'll get second answer. If I use income as a base, I'll get the third answer. Then I will do the valuation under all the three approaches and take a simple average. Nothing is given, take a simple average, and that will be the value of this firm Cranberry. So first I will give you a note on chop shop approach. Write down note on chop shop approach. Under this you write down steps involved. Chop shop approach is used for a diversified company where they will identify each business segment and do the valuation of each business segment separately. So write down steps involved, note 1. Steps involved, note 1. Identify the firm's various business segments. Identify the firm's various business segments and calculate the average capitalization ratio for firms in those industries, and calculate the average capitalization ratios for firms in those industries. That they have done in the second table. Then step 2, calculate a theoretical market value based upon each of the average capitalization ratios. Calculate a theoretical market value based upon each of the average capitalization ratios. So for each segment, using each approach, we'll find out the market value, then average the theoretical market value, and then I will take the average, because different approach will give me different answer. And as you know, valuation is an art, it is not a science. There is no final answer in valuation. It is always based on estimates, and therefore multiple approaches are there. So when multiple approaches are used, we will take average under different approaches. So third step, write down average the theoretical market values to determine the chop shop value of the firm. Average the theoretical market values to determine the chop shop value of the firm. Okay, so one by one we'll solve. Very easy question. First I will use sales multiple. Now in this question, to confuse you, they have given sales upon capitalization is 1.18. Sales upon capitalization is given 1.18. But if I want to know capitalization upon sales, it will be 1 upon 1.18. That means the market capitalization to sales ratio is 1 upon 1.18. Market capitalization is 1 upon 1.18 times of the sale. Is it right? So what I will have to do, first I have to take the reciprocal of each of them and then solve. So write down first step 1. Very easy, I am not explaining much, only this part I wanted to explain. Value using capitalization to sales ratio. Value using capitalization to sales ratio. Under that, write down 4 columns. Business segment. Now in your question, sales to capitalization is given, and that is where the students have made mistake in the exam. In one exam they have given capitalization to sales ratio, so then directly multiply by sales. But if they give you sales to capitalization, you have to take the reciprocal. Mathematically, it means sales divided by capitalization is given. But I want to know how many times is market capitalization for 1 rupee of sale. So 1 by 1.18, 0.85, 1 by 1.1 divided by 0.83, 1.2, 1 divided by 1.25, 0.8, and these are the sales given to you. Sales given in the first table. Multiply now. Multiply. Please multiply and tell me whether this total is right or not. If it is right, I will go to the next calculation. Do the calculation and check if it is right or not. If I apply capitalization to sales ratio, the value of the firm is 3055250. Is the calculation right? Please reply yes or no. Is the calculation right? Can we go to the next calculation now? Write down next calculation, step 2. Value using capitalization to asset ratio. Value using capitalization to asset ratio. Value using capitalization to asset ratio. Same format, business segment. Now read your problem. They have given you asset divided by capitalization. But I have to take capitalization divided by asset. Segment asset and theoretical value. In this question, for all the three firms, the ratio given was 1.43. So I will take 1 divided by 1.43, which is 0.7, 0.7, 0.7. Segment asset given in first table, 6 lakh, 5 lakh, 40 lakh. Just multiply and take total. This is a very practical question because in India there are many companies which are diversified like ITC, HUL. So you can't apply only one approach for valuation. You have to apply multiple approaches for valuation and they have different segments. So this way the valuation is done for conglomerate companies which are into multiple business lines. So is the answer right? 35,70,000. Is the answer right? 35,70,000. Can we go to the step 3 now? Write down step 3. Value using capitalization to income ratio. Value using capitalization to income ratio. Here also institute has given operating income to capitalization, but I want capitalization to operating income. So take the reciprocal. Do you watch Shark Tank on TV? Sometimes, not every day. You have got exam. There they are using either this sales to capitalization or income to capitalization method when they answer the valuation of the potential candidate. Okay, most of the time you will find these are the two ratios they are using, either it is based on income or based on sales. And if the candidate comes who are into different business, sometimes they use two methods for valuation. So do the calculation and give me the answer. I am not a brand ambassador of Shark Tank, okay? I don't get any influencer fees from there. So tell me the total of the last column. Check the answer. Is it 4675000? Yes. Now once you have completed all the three answers, your answer is still not over because these are three different values under three different approaches. So you have to take the average now. So take me the average of the three values, simple average of the three values. So you will write below this step 4. Step 4, write average theoretical value of the firm. Average theoretical value of the firm. Average theoretical value of the firm is equal to take the total of the three divide by 3. How much is the answer? Preeti has replied 3766750. Wonderful, Preeti. Amazing. Rishabh has also replied. Same answer. Very good. Slightly different answer by Rishabh. Check your answer again. So this answer is over. There is one question number 5. So that will take tomorrow. Thank you very much for joining me and wish you all the best.
Are you feeling overstressed by your CA syllabus? Get the best CA revision lectures by top CA leaders, specially designed to boost your confidence and knowledge. And the best part of the lecture is that they are available at super affordable prices and available at any time, anywhere. So hurry up and place your order from our website vinod.in. It is a perfect solution for your last minute revision.